Welcome to the European market open. A minute to go until the start of cash equity trading. I'm Tom McKenzie in London. Here are your top stories. Omicron optimism. A study shows hospital risk for the variant is 2/3 below Delta. The US approves Pfizer's COVID pill. It's the first of its kind. Risk on. European futures point to gains at the open as hopes continue that the recovery can weather Omicron. And the risks for retail. We'll speak to Anita Balchandani of McKinsey about the challenges for the sectors as we continue to navigate the pandemic. It is the 23rd of December. Welcome, everyone. Let's take a look at the futures then as markets weigh the implications of an improving outlook then when it comes to Omicron. The data is coming through, as we said in the headlines, suggesting that it is less severe, results in fewer hospitalizations than the Delta variant. We need to build on that. The scientists do, but we're getting something of a clearer picture. The treatment's coming through as well, with Pfizer approved. AstraZeneca's third shot seemingly adding to the ability to ward off severe illness. The futures are pointing to up after gains yesterday stateside. The S&P 500 back and close to those record highs. The FTSE 100 is gaining 0.1%. Here in the UK, it is worth mentioning that we did get 106,000 recorded cases of the virus yesterday. So continuing to put pressure on Boris Johnson, his government, as they weigh up the need or not for additional restrictions. The CAC down over in France getting 0.3%. Spain is higher by 1/10 as well. That is the picture broadly. Just in the first few seconds, we'll have a look across cross assets then and see if the futures stateside are pointing to additional gains following the upside we saw yesterday. Yes, up 0.1% for the US futures. We'll see if that holds. The US 10-year yield at 146, still comfortably below that 150 level that many eye as a crucial level. Brent is flat at $75 a barrel. You did see inventory stateside being drawn down, putting some support under the oil price yesterday. Gold is at 1,800, up 0.1% above that $1,800 level. Okay, let's get the Bloomberg Business Flash now with Angel Feliciano. Angel.
Hey, Tom. Tencent is to distribute nearly its entire stake in JD.com, worth more than $16 billion as a one-time dividend. The surprise move to divest most of its holding in China's #2 online retailer comes as Beijing punishes the country's tech giants for monopolistic behavior. Ryanair has cut its earnings guidance as Omicron surges across Europe. The Irish low-cost airline now anticipates a net loss of up to 450 million euros for the fiscal year after travel restrictions weakened in Christmas bookings. Ryanair says it will cut January capacity by 1/3. The U.S. Federal Trade Commission is pushing forward with antitrust scrutiny of Amazon's cloud business. Sources tell us investigators have been contacting companies in recent months to gather information related to Amazon Web Services. The division is the web giant's most profitable business. And that's your Bloomberg Business Flash. Tom.
Angel, thank you very much indeed. Okay, let's get into the key market drivers with our markets editor, Christine Aquino. Christine, some support here for the equity markets, Omicron and the risks around that variant looking like they're going to be reduced. And then you had boost in terms of the consumer sentiment index out of the US yesterday as well. Do you expect this rebound to continue towards the end of the year?
Well, Tom, very big question there, but I think, for any rebound or any move really in markets, what you really need for sustainability is volume and liquidity. And that's just something that we don't have right now. And, while we're getting more good news in the Omicron situation, and there's definitely a climb down from the very risk-off tone that we started this week with, I think it's too early to say whether we can see this continue into the new year, because again, given the current state of trading at the moment, it can very much turn on a dime if, for instance, we get more negative headlines coming through over the next couple of days and into next week as well. And so, while this is good for a short-term bounce, we're definitely seeing some of those more battered sectors at the start of the week getting more of a boost today because of these headlines that we're seeing. I think it's too early to call it out of the woods just yet for some of these more weaker sectors that we've seen.
And to your point, we have a line crossing after a number of different pieces of information and bits of news suggesting that Omicron is less of concern. A line crossing out of Hong Kong suggesting that for Sinovac, the third shot, a booster, is inadequate versus Omicron. Significant implications for China, significant implications potentially for supply chains, the economy of that country, and all the nations that have been supplied with Chinese vaccines. How should we be thinking about the risks emanating from China and its inability to really keep this at bay, given the inefficiency of its vaccines?
Well, Tom, I think that's going to be a very big factor heading into 2022. Again, it's a very big deal if you have the world's second biggest economy once again being plagued by issues related to the virus, and these negative headlines and latest developments aren't helping there. And of course, we also have to think about how that fits into China's broader pivot to easier policy. At the very least, there's some good news there for investors in the sense that, you have the Chinese central bank and Chinese authorities pledging to provide support for the economy. So that's at least a bit of a cushion there if we do see the economic situation deteriorate further on the back of this. But definitely worth watching to see if there are longer term growth implications here, especially if we see more widespread lockdowns and more cities getting shut down in China as a result of the spread of Omicron.
Yeah, absolutely. When we look at the sectors in today's moves, travel and leisure at the top of the list, near the top of the list, along with autos gaining about 0.8%. Bottom of the list, just one sector that's in the red so far, Christine. Financial services down 0.2%. What do you make of the moves within the different markets here, within the sector breakdown that we're seeing?
Well, Tom, I think very much clear why travel and leisure are the big winners today. And all of these potentially more positive headlines with relation to the boosters and the efficacy of various vaccines definitely helping that sector. But once again, we have the counterpoint of it's definitely not out of the woods. I think year to date, it's still very much the weakest sector out of all the Stoxx 600 sectors. I think it's due for a gain of less than 1% compared with the rest of it. And headlines like Ryanair's profit warning certainly not helping. I think the key now would be to watch for more guidance from other companies in this sector for 2022 and what they're seeing there, and whether they're bracing for a weaker profit outlook, especially given the holiday season at the moment is not looking as buoyant as they perhaps expected.
We're looking, of course, for any commentary from the Russian President Vladimir Putin in the next hour or so as he gives his annual press conference. Anything on energy, of course. We're seeing oil currently down by 0.2%, but it moved up to $75 a barrel yesterday on the back of the IEA report on inventories out of the US. What are the factors playing into oil for 2022?
Well, very much the demand question in relation to Omicron and whether, again, we see more widespread lockdowns and how that plays into demand. And of course, very important as well, how we see the OPEC Plus group responding to that, whether this is something that they see as an urgent enough matter to put in place measures immediately, or would it be something that they would be happy to let it play out and sit back for a bit, hold their powder, and see how this all shakes out in terms of impact. And for Russia specifically, of course, it sits at a very interesting juncture because, of course, it's winter time in Europe and is a crucial supplier of gas and energy to this region. So very much at an advantage there. Again, we're seeing the ruble, for instance, today creeping higher just ahead of Putin's remarks. And it's really had quite a run this year. I think it still holds the title of one of just the three emerging market currencies that are up and have held on to gains this year, very much a factor of Russia's unique position as far as its role as an energy supplier to Europe goes.
Okay, Christine, we're having some issues with the line there, some technical issues, but thank you for running us through some of the key drivers of the market action as we head towards the Christmas holidays. Of course, December the 23rd, one day away from Christmas Eve. Thank you, Christine, for those insights. Let's check in on the movers then. A couple of corporate names we want to bring into attention for you. There's a deal by Flutter, the online gaming company, for its Italian counterpart, Sisal. This is a £1.6 billion deal. So Flutter, formerly Paddy Power, Betfair, buying this from CVC Capital Partners. They expect it to complete in the second quarter of next year, building out, it says, its geographical footprint within the regulated online gaming space. You're seeing gains of 2.5% there for Flutter. Ryanair is gaining 0.4% despite coming out and revising its guidance on the back of these additional restrictions that we've seen in the last few weeks. It now sees a net loss of between 250 to 450 million euros in the 12 months through March. That's up from the guide of 100 to 200 million euros previously. And Continental gaining close to 2%. This is after reports that the CEO is pretty bullish on margins at the upper end of its projected range. They're going to adapt to pricing because of input prices have increased, of course, for that company. They do see semiconductors and that shortage easing in the second half of next year. That is a picture across the corporate space, some of the names that are in focus for us today. Coming up, we'll focus in on Omicron, of course, as Pfizer, how their COVID pill approved for use, emergency use, and studies from South Africa and the UK paint a clearer picture of the latest variant. This is Bloomberg.
When you talk about the commercial viability, the idea that these companies can actually make money off of this here, does this become, I guess, something that's niche in the sense that you have to pay several $100,000s to do it, or does it come back down to a level where just regular folks like you and me will somehow find a way to be able to take a trip up, and this can be a business model that will be sustained?
I think it's important to note that space tourism is a small segment of the overall global space economy. Space tourism accounts for $1 billion of a global $350 billion global space economy.
What's the rest of it?
$260 billion of that is satellites, manufacturing them, launching them. And these satellites we use in our everyday lives, whether that's to listen to the radio, to watch Bloomberg on our satellite television, or to navigate us to our destination via GPS. And I hope in the near-term future, we will add getting our internet from space.
How will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap in between people that were worried about climate and people that were taking action.
Welcome back to the Open. We are 12 minutes into the European trading day. You're seeing gains of 2 to 3% across the benchmark stocks Europe 600. It is travel and leisure that is at the top of the list as we weigh up the changing data on the severity of Omicron. Studies suggesting that it is less severe, results in fewer hospitalizations than the Delta variant. You also had the fact that consumer sentiment as well, stateside, came in more positive, and you saw rallies in the US trading activity back, the S&P 500 closing in to the record highs. And you're seeing gains for the US futures of about 0.1%. Let's check in then on some of the airlines on the back of this data. And again, the approval of Pfizer as well. Emergency use for the COVID pill. It's the first time we've had that kind of treatment, and how that is going to suggest and how that is going to play into how this disease is dealt with. So you can see Wizz Air is gaining 2.6% again on this readjustment to the threat of Omicron, the reduced threat of Omicron, it seems, at least from these studies. IAG gaining 3%, Lufthansa as well, up 1%. Of course, we have had restrictions put in place from the likes of Germany and France, particularly for UK travellers. Whether or not you start to see governments reducing those restrictions will be a factor, of course, for the travel and leisure sector. Let's get back then to the details of Omicron, how this is playing out for the markets. The variant appears less likely to land patients in hospital, as I've been saying, than the Delta strain. That is according to preliminary data from a trio of studies. We've had a range of virus data that's boosted markets in the past day. The US has now approved the use of that Pfizer pill to treat patients with COVID, and AstraZeneca's booster shot has been found to be effective and increased antibodies against Omicron. Let's get into what this all means then for the markets with Ian Steely, JP Morgan Asset Management International CIO for fixed income. Ian, thank you for joining us this Thursday morning as we wind up towards the end of the year. As you look at the response from central banks, the dot plot outlining 3 rate hikes from the Fed in 2022, and we weigh up the implications of Omicron, how do you layer on what we know about this variant to how it changes or not the response from central banks, notably the Fed?
It's been, I think, well, we've had an interesting 24 hours. Obviously, as you've pointed out, the news has been on the positive side when it comes to Omicron. I think the question that we've had within markets really for the last few weeks is that transmissibility versus how severe the virus is, or this variant is going to be. And it looks like the severity is coming down. Is it coming down enough to offset the increased transmission of it? I think there's still a lot of questions to be answered on that, and we should be getting more information as the days go past, particularly here from the UK. But I think this is so far been good news from a central bank standpoint. But I actually think central banks made a fairly strong statement last week where they had probably the ability to push some of these decisions into 2022, given the uncertainty around Omicron and what it actually means. And they chose not to. And you consider the Bank of England hiking interest rates, the Federal Reserve speeding up the tapering process and indicating that they expect 3 hikes next year. So for this sort of verifies, I think, what the central bankers were thinking is that when they look out from a longer term perspective, they're still more concerned with the pickup in inflation and how it hasn't been as transitory as they'd expected earlier in the year. And that really seems to be their main focus at the moment. As I say, the news in the last 24 hours is probably more positive to that decision.
So prescient calls, arguably, for the central banks then as they look through the Omicron risks. And you talked about inflation. It came through on the Bloomberg survey as the #1 risk for our survey participants for 2022. You have a base case that we're going to see. This is the 80% base case. You're going to see trend growth for 2022. There's a 5% risk of a recession. There's a 5% risk of subpar growth. Just unpack that view for us, Ian.
So our base case is actually 80% for above trend growth. We still think it's a very buoyant environment. We still see, even though the central banks are starting the process of taking away some of the extremely accommodative policy, financial conditions are still exceptionally loose at the moment. That should be continuing as a positive for risk markets. We know we had a little bit of a wobble in the Build Back Better plan earlier this week, but we do expect something to pass from the US, which means there will continue to be fiscal support, and the consumer and the corporations around the world to us look extremely healthy at the moment. So we do see a good environment from a growth standpoint. I think inflation is probably one of the areas that is definitely a concern. We are also concerned. Look, inflation is going to come back down over the coming year. The question is just how much. The Federal Reserve said 2.7%. So, that's at the higher end of people's expectations. I think if we do go on that trajectory, though, markets will become quite comfortable with that move.
Which parts of the economy, which parts of the corporate space are most sensitive to what many would argue is now a paradigm shift from central banks?
So I think it's the parts of the economy that rely on low interest rates. So as you get rates moving higher, some of the financing costs could become a concern. But actually, when you think about what these companies have done over the last few years, they have been terming out debt. They've been borrowing at very low rates for as long as they possibly can. We've seen real extensions in duration of corporate bond indices. So that's very, very supportive. And they're sitting on a lot of cash at the moment. They've built up these big cash buffers. So all in all, we just see corporates being in a really good spot, that even if you do see rates go from the zero lower bound up towards 1% from the Federal Reserve or from the Bank of England, it shouldn't be a really big hindrance from a corporation standpoint. It really is probably more as we would get towards the 2.5%, and some of these corporations then needing to refinance, that you might start to take a look at it. But actually, that's still some way off. I say financial conditions still extremely loose at the moment.
Okay, the robustness of these corporates and their balance sheets as we look to a terminal rate, maybe 2.5%, as you say, still some way off. Ian Steely, JP Morgan Asset Management International CIO. I'm very pleased to say for fixed income, staying with us. We'll get his calls just in the next few minutes. Coming up, as we put 2021 behind us, we will get, as I say, Ian's take on what to expect next and where he thinks we should be focused within the fixed income space. If you have any questions of your own for our esteemed guests, please send them to us on IB Plus TV Go. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Maybe I'm just in the festive spirit that I think that we're in a bit, or going to be in a bit of a sweet spot.
So it might seem strange now, just when inflation is really taking off as an investor risk, that we've decided to actually call time on that view, and we've decided to move back to a more neutral view.
No one really understands what drives CPI.
We are very mindful of potentially a Fed policy mistake. So, you know, it's a bigger risk than the Omicron.
I think the role of the coronavirus and the pandemic in these disruptions is absolutely critical and probably not emphasized sufficiently.
A lot of those supply chain issues beginning to resolve themselves just sort of by the natural functioning of the markets.
We have characterized 2022 as a year of volatility.
It's always challenging. There's always uncertainty.
I believe at VanEck that investors should really look through the noise to identify where the long-term growth areas are.
Pretty favorable environment for staying overweight equities.
Key market voices there speaking on Bloomberg TV about the market risks they are watching as we enter 2022. Welcome back. December the 23rd to the European Open. We are 23 minutes into the European trading day. Gains of 0.2% across the European stocks 600. We are risk on. Apart from the FTSE 100, down 0.1%. Consumer staples and healthcare pressuring the UK index. Every other major index across the European space is seeing modest gains after that upside that we saw stateside. Okay, let's get back to Ian Steely, JP Morgan Asset Management International CIO for fixed income. Still with us. Ian, how much and to what extent do you want to be dialing back risk within the fixed income space as you look to 2022? Are you still comfortable being in high yield, in the junk space to get that yield?
I think you are, because as I said earlier, corporate health looks particularly good to us at the moment. You're still getting, if you think about the US high yield market today, you're still getting a spread. So the difference between the yield you get on high yield and the risk-free rate, the government bond rate of north of 3%. And our expectation is that when we look forward, we're going to still see a very low level of defaults, below 1%. We're currently at the moment at the lowest on record ever. And if that's the case, then actually you are still being compensated to sort of take these credit risks at the moment. I think where the big concern from a fixed income standpoint is going to be next year will be your duration component, because we're still in a very low yield environment. We've still got 10-year US Treasury yields sub 1.5%, and the Federal Reserve have told us they want to be raising rates 3 times over the next couple of years, or both the next 2 years, which would put the cash rate around about that sort of level, which means we really expect Treasury yields to move higher. I think it will be quite an interesting environment, because if I look back at the Bloomberg indices, the US aggregate, the global aggregate index, they very rarely have negative years, and both of them have never had 2 negative years in a row. This could be the time when we see that. They're both negative currently to the tune of 1.5% or 1% this year. It could well be that we have negative returns again next year, which means you want a more active, dynamic duration management, and to be a bit more flexible within your fixed income allocation as we look into next year.
Ian, what's your regional bias for next year?
So I still think you need to be playing the US market from the short side. I still feel that it's going to be Treasury yields that move higher, particularly higher than what we would expect within European markets, as we wouldn't expect the European Central Bank to be able to raise rates anywhere near to the same extent. And then I think emerging markets from a regional standpoint look really interesting. And emerging markets are a really tricky one at the moment. They've obviously had a pretty tough year over the course of 2021. And if we're sitting here in 12 months' time, I think we're going to be saying it's obvious they're either going to be the top performing asset within fixed income, or they're going to be the worst. And at the time, it will be obvious, because they'll be the best performing because the valuations are so cheap and they look really attractive compared to other parts of the market, or they could easily be the worst performing because this is an environment where central banks are taking liquidity.
Ian,
I'm going to go for the former.
We're out of time. Ian Steely, JP Morgan Asset Management, we wish you a very happy Christmas. Stay with us. This is Bloomberg.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the Open. We are 30 minutes into your European trading day, and here are your top stories. Omicron optimism. A study shows hospital risk for the variant is 2/3 below Delta. AstraZeneca says a booster shot of its vaccine increases antibodies against the variant. Risk on, European stocks and US futures gain as hopes continue that the recovery can weather Omicron. And the risks for retail. We'll speak to Anita Balchandani of McKinsey about the challenges for the sector as we continue to navigate this changing pandemic. Okay, we are risk on across the broader European space. You had the upside of Wall Street, you had gains in Asia. The consumer business, or the consumer sentiment index stateside, pointing to optimism amongst US consumers. And then we have these studies around Omicron suggesting that it is less severe than Delta. All of that playing in to what we're seeing towards the end of the year. Of course, December the 23rd, Christmas tomorrow really gets underway. The European Stoxx 600 gaining 0.2%. The DAX is up by 46 points. You're seeing gains of the CAC Garonne of 0.1%. The FTSE 100 is lower. That's healthcare and consumer staples, but is paired some of the heavier losses. It's currently essentially flat. The FTSE 100 range bound is how I would describe it. In terms of the individual sectors, let's switch it on and have a look at how things are playing out. It's not a big surprise. Travel and leisure is back, gaining almost 2% again on the optimism around a less severe Omicron, potentially, as the studies suggest. Ryanair, though, coming out and suggesting revising down its guidance for the full year on concerns about the impacts of restrictions. Auto parts also gaining 0.8%. Bottom of the list, you've got food and beverage, healthcare, media, and financial services, maybe weighing up the fact that yields continue to be capped. It seems below 1.5%. The trajectory of yields in focus for us as we look to 2022 and potentially 3 rate hikes from the Fed. Okay, let's switch focus and delve into one particular sector of importance. With much of the world in and out of pandemic restrictions since 2020, the global fashion industry has faced exceptionally challenging conditions. But after nearly 2 years of disruption, the sector is beginning to find its feet. That is the view of McKinsey in their latest retail outlook. Joining us now for more on the state of fashion and the retail sector, I'm pleased to say, is Anita Balchandani, partner at McKinsey. They've been doing a deep dive, looking back at 2021 and looking ahead to the implications for next year. Anita, good morning. Thank you for joining us. Let's start with the here and now of Omicron and how it is impacting the broader fashion, the broader retail space. What are you seeing? What are your clients telling you? What is the data showing you?
Good morning, Tom. And I think with Omicron, we're seeing sort of, we'd always anticipated an uneven recovery to be one of the hallmarks of 2022. And I think we're starting to see, as consumers came into this holiday season and particularly into November with an appetite to consume and splurge. We've seen a lot of pull forward of that holiday spend. And we also continue to see that Omicron is sort of a signal, if you will, of some of the unpredictability that the sector will have to contend with. And that unpredictability, Tom, we expect to see sort of play out in a couple of different dimensions, right? One, the recovery we expect to be uneven by geography. We're certainly seeing that China and the United States have been, relatively speaking, the most resilient. Eurozone, to some extent, also compounded by the absence of long-haul travel into those countries really being impacted. So we expect the outlook to be uneven in that sense. We also expect to see a bit of a twin track around luxury and non-luxury, and the pattern around luxury being, relatively speaking, more resilient as we look into 2022.
Okay, let's talk about that divergence then that we're seeing regionally and the shift, the focus from China, the US, to what's happening in Europe. And you think Europe maybe is going to be a bit of a laggard. Do you have a time frame? What is the time frame to kind of getting back to pre-pandemic levels?
So the outlook around Europe is really to get to pre-pandemic levels in the 2023 sort of horizon. And again, this is going to be, quite marked across, if you think about the luxury sector. A good proportion of that was actually reliant on long-haul travel into Europe and spend, which has now been sort of repatriated, say, more into China. So we do expect to see Europe on a slower recovery curve. Having said that, we also look and identify sort of the top 20 winners in our State of Fashion 2022. And it's really interesting to see that of the top 20 globally, 10 of those, so 50% of those are actually sort of companies based out of Europe. So to some extent, it does sort of point to the relative resilience of companies in the sector that are based in Europe.
And you touched on this, the divergence between luxury and then the mid-end of the sector. What are we seeing in terms of the pressure within the mid-end, in terms of bankruptcies, buyouts? Is that expected to accelerate in 2022, or are we kind of peaked?
So, Tom, we're certainly seeing the top 20 have been relatively resilient over this period, and some of them have actually even ended up with economic profit levels ahead of that pre-pandemic. However, if you look at the sectors in aggregate, the proportion of companies that are now in value destruction territory is at a record high, with roughly 70% of companies in the sector in now sort of classified as value destroyers from an economic profit standpoint. So I think it does point to the polarization and that there are definitely two sides to this coin in the fashion industry.
What about supply chains? I mean, this plays into that. That's 70%. That's quite a remarkable statistic in terms of demand reduction, or you say the pressure that was in 70% of that sector in terms of value destruction, I should say. And part of that surely is the input prices, the supply chains, all of those additional constraints on this sector. How are they working through these issues? How much resilience is there?
Look, the supply chain in this industry has historically sort of really been optimized around cost efficiency, and I think we've seen some of the choke points of created through the pandemic that are now flowing through and creating pressures for everybody. What's also clear from us is this is the first time from our survey of executives that we see 66% of executives believe that price rises are an inevitability as a consequence of this. The expectation being median price increases in the region of 4 to 9%. So we're starting to see actually huge pressures either on pricing or indeed on margin coming through into 2022.
Okay, so further price increases for next year, implications, of course, for the consumer. Talk to us about technology as well, Anita, the shift, of course, online, but also the use of blockchain. I found this intriguing within your survey, the move to use blockchain to kind of superpower some of these connections and supply chain issues.
Absolutely. And Tom, kind of the blockchain sort of opportunity really sort of comes in, one, around the supply chain, as you say, two, also around traceability and enabling sort of the industry to solve this big challenge as it strives to get more sustainable. And probably the biggest element around technology here is how can technology now sort of operate in a way that the boundaries between online and offline are dissolved? And certainly the players that we found have been much more resilient in their response to the crisis have been those that have actually been able to use their entire portfolio of physical assets, be their distribution centers and stores, indeed to serve customers regardless of whether they're shopping online or offline, because we've seen huge amounts of volatility around foot traffic versus web visits as people have sort of been really trying to figure out whether they should be shopping online from the comforts of their home or whether they should be in the store. So we think the opportunity around inventory visibility, traceability, accuracy, etc., is enormous.
Okay, Anita Balchandani, really great insights into the fashion and the retail sector, partner at McKinsey & Company. Expect further price rises next year. 70% of this sector looking at value destruction. Thank you for your insights. Have a great Christmas. Okay, let's get the Bloomberg First Word News now with Angel Feliciano. Angel.
Tom, the Omicron variant appears to result in fewer hospitalizations than other COVID strains, according to a trio of studies. Researchers in Scotland found Omicron was associated with a 2/3 lower risk of hospitalization compared with the Delta variant, though it was 10 times more likely to infect people who'd already had COVID. The data adds to findings from South Africa showing people are 80% less likely to be hospitalized if they catch it compared with other variants. Spain is to reintroduce mandatory face masks outdoors while ruling out lockdowns for now as the highly contagious Omicron variant sweeps across Europe. France has reported a jump in infections with more than 84,000 yesterday, up by almost 20,000 from a week earlier. The UK, meanwhile, saw more than 100,000 positive tests in a day for the first time. The Chinese city of Xi'an has imposed a lockdown on its 13 million residents after mass testing identified 127 COVID infections. Residents have been told to remain in their homes and designate one person to go out every other day for necessities. It's China's biggest such move since the pandemic started in Wuhan approximately 2 years ago. A third dose of AstraZeneca's COVID vaccine has been found to significantly boost neutralizing antibody levels against Omicron. Lab studies at the University of Oxford found a third dose produced higher levels of antibodies than found in individuals who had recovered from an infection with an earlier COVID strain. Chinese President Xi Jinping has told Hong Kong leader Carrie Lam that the city is developing in a good direction. It was their first face-to-face meeting in 2 years, coming days after an election in Hong Kong which installed Communist Party loyalists. Local media reported that Xi praised changes made to the territory's electoral system. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom.
Angel, thank you. Okay, coming up, Russia builds up forces near Ukraine. Even as the US offers talks, we hear what Eurasia Group President Ian Bremmer has to say about the rising tension. That is next. This is Bloomberg.
Worker perspective, a recent headline, you got Kellogg's Cereal Union says the latest agreement that they had was rejected. Deere had to finally make a union contract. How concerned are you about the longshoreman contract and union negotiations right now?
Well, we're some time away from that. The contract expires on the 30th of June next year, and both sides have told me that they'll sit down to the table and begin negotiating in May. These are always important discussions, and usually when the spotlight is on our industry. But there'll be some issues around wages. The industry is making a lot of money. The longshore folks would like to see that. Now, I don't speak for either side, but training and development of the workforce will also be key as robotics and automation are front and center. The workers cannot be left behind.
Yeah, but to that point, I mean, do you feel like the balance, though, has shifted? I mean, for so long, workers had a lot less negotiating power. Do you feel like the pendulum's shifting?
The International Longshore and Warehouse Union, which does work across 29 West Coast ports, is very strong and a democratic organization.
Container ship blocking the Suez Canal.
Types of crypto coins.
Crackdown on tech in China. The billionaire space race.
Delta variant.
Chip shortage. Rising energy prices. The Omicron variant has triggered.
Welcome back to the Open. We are 44 minutes into the European trading day. Gains of 0.2% across the benchmark. European stocks 600. It is travel and leisure that is at the top of the list with your sectors. In terms of your sectors, gaining 1.8% on this relief that Omicron is potentially less severe than the Delta variant. The boost there for the travel and leisure sector. Red on the screen for food and beverage, consumer products and healthcare as well. The FTSE 100 is range-bound, flat essentially, but you're seeing some optimism in Germany. The DAX gaining 0.3%. Let's check in on one of the big corporate stories of the day, certainly from Asia. Tencent coming out with a surprise decision to have a special dividend, which is from its JD holding. It had about 20% of its stake in JD, about 20% of JD stocks held by Tencent. Is going to be reducing that to a little over 2%. Part of the special dividend, giving the JD.com shares to Tencent's own shareholders. You saw a boost for Tencent, but all the other companies that Tencent is invested in, at least a number of them, under pressure as a result of this. Not just JD.com, but the likes of Meituan, Bilibili as well, Kuaishou, the video sharing company. This is because Tencent is an absolute behemoth. It's huge when it comes to investing, far bigger than any VC in China, investing in individual startups. And it looks like this is a bit of a sop to the Communist Party of China, who of course have been pressuring these companies to reduce some of their cross-holdings across the tech space. So the question for investors is, does Tencent start to reduce its stake in other companies that it's invested in? We don't know yet, but this is significant. It is a surprise. We haven't seen anything like this from Tencent for a long time, and we will continue to be across this corporate tech story for you out of China as the regulatory environment there continues to evolve. Let's switch focus to what's happening in terms of energy and the geopolitics of Russia. It's continuing, that country, to build up forces close to Ukraine, even as it's preparing for security talks with the US. Yesterday, Germany's Foreign Minister, Annalena Baerbock, expressed her, quote, great concern over the further troop movements and called for dialogue. The US and its European allies have warned Russia of massive consequences if it attacks neighboring Ukraine. But even as tensions grow, Eurasia Group President Ian Bremmer played down the prospect of a possible invasion. He spoke to Bloomberg's David Weston.
I think that there is a reasonable likelihood that the Russians will engage in some form of escalation. But I don't think that means invasion into Kiev and overthrowing the government. And the problem we have is that the United States, I mean, we have coordinated with our allies in advance of the Putin meeting that Biden had a couple weeks ago. David, that was the absolute right thing to do. We want everyone on the same page. And we made clear there are going to be very tough sovereign debt sanctions, primary and secondary. Nord Stream 2 won't happen. The pipeline to Germany, it'll stop, won't go operational. And we will forward deploy troops if they invade Ukraine. Okay. But what if they don't invade Ukraine? What if they formally annex the territory that they already have because they say that the Ukrainians are engaged in acts of genocide against ethnic Russians, which Putin is saying, even though it's not true? What if they do that? How do we respond? And I worry that the Americans and Europeans aren't as coordinated on that issue. I also think it's important for us to remember that Russia's interest is not just in ensuring that they have a veto power over Ukrainian foreign policy. It's also in weakening and dividing the transatlantic relationship. And anything that they can do to create a big security concern and have the Europeans in one direction, the Americans in another, that's a very serious problem. It's one that the Americans are going to have to address more forcefully than we have in the coming year.
Let's turn to another issue, which is not a confrontation, but it's an issue nonetheless, which is Turkey. Certainly Turkey is struggling, I think it's fair to say, with President Erdogan's rather particular approach to monetary policy. What is going on in Turkey?
Yeah, he's one of the most unorthodox interventionists as a president in an emerging market in their economy. And we've seen the lira fall to records as a consequence of that. And there's been a lot of capital flight. Big restrictions being putting on in terms of types of trading that can be done. And certainly soft capital controls are likely in the near term. But Turkey's going to be under a lot more pressure in the coming year. You know about the supply chain challenges. We know about tourism being cut back by Omicron. Again, Turkey's very, very important tourism, a part of its economy. And of course, I mean, with no more free money, with the Americans ending quantitative easing, with no more big relief, no more special drawing rights from the IMF, the macroeconomic condition for all emerging markets is going to be much, much more challenging. And Turkey is probably among the least capable of major emerging markets to actually weather that. Erdogan's approval ratings right now are at the worst of his entire presidency, and that has further to fall.
Eurasia Group President Ian Bremer there on all things Turkey and Russia. Coming up, almost a year since the UK technically severed ties with the EU, we look at the impact on finance and the City of London of Brexit. That is next. This is Bloomberg.
Urban areas are most vulnerable to climate change. Cities consume 78% of the world's energy, while also generating 60% of greenhouse gas emissions. By the year 2100, 85% of the world's population is expected to live in cities. 90% of all urban areas are coastal. And with sea levels rising, 800 million residents are likely to be affected. 1.9 degrees to 4.4 degrees Celsius is the projected increase in urban temperatures around the world by year 2100. By 2050, 1.6 billion people are projected to be vulnerable to chronic extreme heat.
Really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back to the Open. We are 52 minutes into the European trading day. A positive handover from Wall Street, a positive handover from Asia. Gains of 0.3% across your European markets. Okay, let's focus in on all things UK. Recap what's been happening over the last 12 months. It has been a year, almost, since the UK technically severed ties with the EU. Today, we are looking at the impact then on finance and the City of London. Joining me now is Bloomberg's UK economy reporter on set, Lizzie Burden. Lizzie, what has the impact been then on the City of London and finance over the last 12 months?
Well, it's not been as bad as some had predicted, but you have seen Brexit pushing finance firms to relocate at least some of their people, assets, operations to the continent. Now, EY says that it would have been worse had it not been for COVID because the pandemic's made it harder to relocate. But you are seeing finance hubs growing in Paris, Amsterdam, Dublin, Frankfurt. You're likely to see more of that in 2022. But the real loss, the immeasurable loss, is the opportunity cost of the jobs that are springing up in the EU that without Brexit would have been British.
And where do we stand? Those are some of the gainers across the European space in terms of the capitals that are getting an upside on the back of this. Where do we stand in terms of the discussions around banks, British banks, their access to the European markets?
Yeah, so the equivalence question, the Brexit Minister David Frost, before he quit and the brief was handed over to Liz Truss, the Foreign Secretary, said that the talks have been put on hold. Now, you remember earlier in the year, the two sides did make some progress. They reached the Memorandum of Understanding, which is different to the equivalence decision. It's largely symbolic, but it does create a framework for regulatory cooperation, a forum for sharing information. But the reason that we haven't reached a decision on equivalence is largely because of the tensions over Northern Ireland. And given that Truss has now taken over, and she said that she's willing to trigger Article 16 of the Northern Ireland Protocol, it's not exactly jolly mood music heading into 2022.
So she's kind of picked up the mantle from David Frost. Obviously, she's inherited David Frost's portfolio when it comes to Brexit, as well as being the Foreign Secretary, but she's also picking up on his hard line, his rhetoric. Is there any sense from your sources you're reporting that things will shift under Liz Truss now that she's taken over the negotiations from the UK side?
Well, she's started out taking a tough stance, but I think what we have to remember is this is the high-level political rhetoric. So they will be working for a solution behind the scenes. And the other thing to remember is that it's all connected. So the talks on finance link into the talks on fish and the difficulties that they're having on migrants. So we're wanting to see those things resolved, but it'll be interesting to see how it pans out with Liz Truss.
A multitude of different issues they have to unpick. Fishing, I mean, for goodness sake, fishing versus the finance industry. We'll leave that for another day. Lizzie Burden, thank you very much indeed, our UK economy editor, getting us up to speed on the implications for UK and its finance sector 12 months into this divorce from the European Union. Let's check in on some of the cross assets then. We're saying this risk on. You're seeing gains of 3 to 0.4% now, further upside for these European markets. The FTSE 100 has even turned positive gains, just of 0.1%, building on the optimism over stateside. Of course, we're getting this data suggesting that Omicron is less severe than the Delta variant. That is part of it. A strong consumer in the US as well. In terms of the future stateside, seeing further gains, building on what we saw yesterday, the S&P getting back to close to those record levels, gains of 0.2%. The US 10-year yield, 1.46 is what they're getting on the US 10-year yield. Not much movement there. $75 a barrel on Brent, down 0.3%. And gold holding above $1,800, up 0.2%. That is a shape of play across those cross assets. When it comes to each individual sector, by the way, travel and leisure gaining 2%. Again, on the optimism that maybe governments will start to ease some of these restrictions in the days, the weeks ahead, as a result of Omicron being less severe, but that is still a big caveat. Nonetheless, travel and leisure up more than 2%. That is it for the European market open. Surveillance, early edition is up next. This is Bloomberg.
An extra $1 trillion in spending, not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the President's its agenda, what I like to call the big deal. But part two of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of healthcare, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Blanket booster programs are likely to prolong the pandemic rather than ending it.
There is a reasonable likelihood that the Russians will engage in some form of escalation.
We'll stand ready to act one way or the other.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London, standing in up 0.9%. Travel and leisure is part of that. The IAG, of course, on the back of the optimism that Omicron is less severe. Travel and leisure gaining 2.5%. Three sectors in the red: food and beverage, consumer products, basic resources. That is the geographical picture on a risk-on mood here as we lead up to the Christmas holidays. Let's check back in then with Vladimir Putin, the president, of course, of Russia, at his annual press conference in Moscow. We'll focus on anything he has to say, of course, about the Russian economy, and he said it's going to grow 4.5% in 2021. Inflation, he's outlined that at 8%, but also anything he says about the energy complex, the supply of gas to Europe, and the geopolitics. So let's listen in to the Russian president.
During the pandemic, when we planned assistance to the most affected industries, 4.5% of our GDP. It's huge last year. And here, this year, 1%, so almost 5.45% of GDP. And this is not just giving money out with this support.
Okay, we'll dip in again with the Russian president, of course. If he says anything significant, that is the Russian president, Vladimir Putin, speaking in Moscow. Let's get some analysis now, particularly on the geopolitical front, with Elizabeth Braw, resident fellow at the American Enterprise Institute. Elizabeth, you were telling me in the break how significant this press conference is in terms of getting clarity, at least a sense of the direction for Russian policymaking on everything from the economy to geopolitics. Front and center when it comes to geopolitics is clearly what is happening on the Ukraine border. What is your assessment of the Russian stance as things stand?
So Putin, as you said, is holding a press conference at the moment. It's the political highlight of the year in Russia, and for us, Russia watchers. But this year, we already knew before it started that there would be a lot of interest in what he's going to say about Ukraine, because Russia is keeping up the pressure at the Ukrainian border. And what's interesting about that is that it's not just the risk of a war, and Putin has said that Russia would be able to invade Ukraine if it decided to. But already without invading Ukraine, it's causing a lot of harm to the country because investors, international money market are losing confidence in Ukraine. So he doesn't even have to do very much more than what he's doing at the moment.
So the economic damage is clear. You've outlined that in your notes for us, that particularly when it comes to investors looking to Ukraine, those who are confident enough at least to have exposure to Ukraine. Is it your assessment at this point, therefore, that he holds off, that he can hold off on military engagement because the damage is being done, at least on the economy?
He can. Depends, of course, it all depends on how big his risk appetite is. But if you consider the risks involved with invading another country and as a result causing some sort of NATO reaction. Now, Ukraine does not have a guarantee that NATO will respond on its behalf because it's not a NATO member state. But some group of NATO member states, including the United States, would be likely to respond in some way to Russia in case of an invasion. But short of an invasion, there's very little anybody can do, because the Russian troops have every right to be on their side of the border, and yet Russia can cause a lot of harm by them being there. So I think the risk of an invasion is low, simply because there would be such a big fallout for Russia if it did cross the border, whereas now there is practically nothing anybody can do.
What is the economic resilience of Russia if they do face additional sanctions on the back of any military action?
That is one of Russia's vulnerabilities, because unlike China, it's not so big that it can sustain sanctions across its economy, and it's already a struggling economy. So that is a vulnerability. But we should remember that Russia's economy is far bigger than that of Ukraine, and also far more resilient because it's bigger. So it's the risk to the Russian economy compared to the Ukrainian economy of the current situation continuing are smaller. But I think that the risk that we should be looking at is Putin losing support among the country's elite, oligarchs, other leading people in the private sector, in the business sector, who may say, well, we are not willing to put up with these sort of punishments from the West anymore. And I think that's what we should be looking at in the months ahead.
Okay, and that takes us to negotiations between US and Russia. How seriously should we take Vladimir Putin's concerns and his insinuation, or at least his commitment to those talks?
He has played a weak hand very well in presenting this proposal to NATO and the United States. And it was interesting that it was to both, not just NATO, but to the United States. Russia clearly wants to be seen as an equal partner to the United States. And now the United States, the Biden administration has already said that it won't be negotiating about European security without the Europeans. So it has essentially turned down his proposal for talks between the two of them at the exclusion of America's European allies. But what he has done is essentially paint NATO into a corner, because NATO and the United States together will have to respond somehow, even though the US has already said it won't negotiate without the Europeans, but they will have to respond somehow to these proposals. And the proposals were quite radical, you might say, in suggesting that Ukraine and Georgia not be allowed to join NATO, for example. Now, NATO and the US will have to respond somehow to this, either by offering an olive branch, or by saying, no, we don't tell which countries, we don't tell countries that they can't join NATO. So it's a very difficult position for NATO at the moment.
What is your sense of the unity or not within the Europeans when it comes to the issue of Russia?
It's, again, a very difficult situation. You have countries like the Baltic states and Poland feeling very strongly that NATO has to be assertive vis-à-vis Russia. Then you have other countries, including France and some countries farther west, that will say, okay, it's not our main concern. Our main concern is A, B, C, D, E, F, and we should at least try to engage more with Russia. We should cooperate more with Russia. And we should remember that NATO and the West more generally has a bigger looming threat, which is China. And it's another country that they have to figure out a joint strategy to figure out how to either work with China or deal more assertively with China. So there is a lack of unity within NATO, quite clearly. We have seen it also with regards to Belarus, where some countries felt that Latvia, Lithuania, and Poland were too assertive vis-à-vis Belarus. And so again, it's nobody's fault. It's that way. It's just where you're located in the world matters greatly, especially if your neighbor is Russia or its friend Belarus.
Okay. Elizabeth Braw, I'm very envious of the bookshelf behind you. Resident fellow at the American Enterprise Institute on the analysis around the geopolitics of Russia. We didn't even get on to the vulnerability of Europe to those energy supplies from Moscow. But thank you for your insights. There's Vladimir Putin live at his press conference, annual press conference, taking a bit of a dig at the US, saying the Fed will have to do something about inflation. He said that Russia is looking at inflation of around 8%. He says, I'm not interfering in the central bank's work, the central bank of Russia and the Russian Federation, of course. But again, saying that the US Fed will have to do something about inflation. We will keep across the story as Vladimir Putin continues his annual press conference. Coming up, COVID 2 years on, as another year comes to a close, we look at how the crisis unfolded and what the future could hold. More on the virus and vaccines next. This is Bloomberg.
cut emissions, climate-proofing transportation is at the top of the list. 20% of global CO2 emissions come from transportation. 75% of transport emissions come from road travel. And 45% of road travel emissions come from passenger vehicles. 29.4% of road travel emissions come from freight. Of the world's transportation emissions, 11.6% comes from aviation, 10.6% comes from shipping, and 1% comes from train travel.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
According to Bloomberg's vaccine tracker, roughly 3.2 million doses of the COVID vaccine had been administered by the U.S. by January 1st, 2021, far short of the Trump administration's goal of giving out 20 million shots before New Year's Day. And the global vaccine effort hit a snag in the spring when vaccines developed by both AstraZeneca and Johnson & Johnson were suspended over blood clot concerns. Within a few weeks, both shots were declared safe to use following reviews by regulators in both the EU and U.S. Before the end of April, Biden hit his goal of administering 200 million shots in his first 100 days, as vaccines had been made available to all adults. The fight against COVID was gaining traction in the summer as vaccines rolled out globally. That didn't last long, as the ultra-contagious Delta variant surged across the globe. By July, the CDC had advised vaccinated people to put their masks back on in indoor spaces as breakthrough cases rose and the agency learned that vaccinated people could still transmit the virus. In the fall, the FDA issued emergency approvals both for booster doses and vaccines for children aged 5 to 11. But late in November, global financial markets sold off after South African researchers identified a new, severely mutated COVID strain that had the potential to evade vaccine protection, the Omicron variant. In response, many countries reinstated travel restrictions from African countries. Japan closed its borders to foreign tourists from all nations, and UK Prime Minister Boris Johnson advised anyone able to work from home to do so. With 2022 on the horizon, the new year will bring with it a lot of uncertainty and big questions about the pandemic's future, including, will vaccines need to be reformulated, and can any ground be achieved without vaccine equity? Despite a pledge of more than 1 billion donated doses from the U.S., many countries have vaccination rates of less than 50% of their populations, and that's where the virus is most likely to mutate.
And that was a look at where we've been so far in this pandemic. Let's get an update then from Bloomberg and the COVID resilience rankings that the team puts together. South America and APAC have been rising up the rankings. You've got Chile at the top as Omicron hits Europe and North America. Joining me now to discuss the pandemic and that resilience ranking is Bloomberg's Rachel Chang. Rachel, what is the outlook then for COVID resilience in the developing world? Are they likely to be hit as hard by Omicron as we've seen in Europe and the US?
Yeah, I mean, I think it's inevitable that every country in the world will have to really face the challenge of Omicron. Some of the advantages the developing world does have is some of them are in the southern hemisphere. They don't get the kind of cold seasons that we're seeing in U.S. and Europe right now. So that will slow down the spread. You know, we do have places, Australia and New Zealand are in summertime right now. South America's in summertime right now. But December's #1 on the ranking. Chile, very much warm weather, highly vaccinated. But at the same time, I think in the developing world as well, there's a real difference opening up between the access to vaccines and the type of vaccines that countries have access to. So a place like Chile, they started off with the Chinese vaccine Sinovac, and they've moved really quickly on their booster shots, probably because the Sinovac was not that effective. But they've now boosted over 60% of the adult population, a lot of them mixing the mRNAs with Sinovac, which we know gives a high level of protection against Omicron. That sort of thing is not really an option for other developing countries like in Southeast Asia, where you have Vietnam, the Philippines, countries that have been at the bottom of the ranking for a long time, still struggling to get that first round of vaccines, and not to mention the booster shots. So boosters are going to be an increasingly important differentiator on the ranking into the new year.
Okay, Bloomberg's Rachel Chang, thank you for those insights. The Bloomberg Resilience Ranking, well worth looking at on the terminal and on Bloomberg.com. Chile at the top, South Africa, Vietnam near the bottom. Let's get your Bloomberg Business Flash now with Leanne Gerrans. Leanne.
Tom, good morning and thank you. Intel has apologized after its opposition to Xinjiang labor sparked a backlash in China. The American chipmaker says it sent a letter asking suppliers not to use any labor or products sourced from Xinjiang in order to ensure compliance with U.S. legal requirements. It says it did not mean to express a position on the matter. The statement comes after Chinese social media users criticized Intel, and the lead singer of a popular boy band said he would terminate partnerships with the company. A third dose of AstraZeneca's COVID vaccine has been found to significantly boost neutralizing antibody levels against Omicron. Lab studies at the University of Oxford found a third dose produced higher levels of antibodies than found in individuals who had recovered from an infection with an earlier COVID strain. Tencent is to distribute nearly its entire stake to JD.com, worth more than $16 billion as a one-time dividend. The surprise move to divest most of its holding in China's #2 online retailer comes as Beijing punishes the country's tech giants for behavior. And that's your Bloomberg Business Flash. Tom.
Leanne, thank you. Coming up, we take a look at the impact on finance and the City of London after a year of Brexit. More on that. This is Bloomberg.
When your shares are down 20%, it's going to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars. only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. It has been almost a year, feels longer sometimes, since the UK technically severed ties with the EU. Today, we are looking at the impact specifically on finance and the City of London, the importance, of course, of that sector. Joining me now is Bloomberg's UK economy reporter, Lizzie Burden. So, Liz, it's been almost a year. Where do we stand in terms of the impacts on the city as these negotiations continue?
Well, it's not been half as bad as some had predicted, but you have seen Brexit pushing finance firms to relocate some of their people, assets, operations to the continent. Now, it would have been worse, EY says, had it not been for COVID, because it's been hard to relocate during the pandemic. But you are seeing the growth of finance hubs in Amsterdam, Dublin, Frankfurt, and that's set to continue in 2022. The real loss, though, the immeasurable loss, is the opportunity cost of those jobs that are being created in the EU that, if it hadn't been for Brexit, would have been British.
And British banks clearly need access to Europe and to doing trade there and business there. Where are we in terms of those discussions? Because there's still a lack of clarity.
Yeah, before the Brexit minister David Frost quit and was replaced on the Brexit brief by the Foreign Secretary Liz Truss, he said that the equivalence decision talks had been put on hold. Now, you'll remember earlier in the year, we did get some progress towards mutual understanding, that's a largely symbolic thing. It's a framework for regulatory cooperation, a discussion forum for sharing information. But the reason we haven't got an equivalence decision yet is largely because of those tensions over Northern Ireland. And given that Truss has already come out guns blazing, saying that she'd be willing to trigger the Northern Ireland Protocol, Article 16, it doesn't seem like jolly mood music heading into 2022.
Okay, interesting insights there as we look back on almost 12 months since the UK divorced itself from the European Union, with a new head, of course, of those Brexit negotiations in Liz Truss, the Foreign Secretary. Thank you, Lizzie Burden, our UK economy reporter. We're going to check back in now with the Russian President Vladimir Putin, his annual press conference. Again, just to recap, he's been making comments about inflation, 8%, the economy at the end of 2021, 4.5% growth. But we are looking for anything specifically on the energy complex, the supply of nat gas to Europe, and anything, of course, that he has to say about that buildup of Russian troops on the border with Ukraine that DC, Washington, and Brussels are so concerned about. Let's listen in then as he is peppered with more questions in what is meant to be, expected to be at least a 3, possibly 3.5 hour press conference.
Afford thousands dying on a daily basis. Can we afford that? Those figures? Maybe some political will is missing. If you show us the will, we'll support you, Vladimir Vladimirovich. I got it. Well, have I ever said that we're being surrounded by enemies? No, there are military bases in the south, in the north. The new weapon systems are being erected, actually, at sea. In the west, obviously, there are military bases. We'll talk about foreign relations later on. But it's very difficult to actually surround us completely because we are a huge territory. But of course, modern weapons allow such a possibility. What about new waves? As far as new waves of corona infection are concerned, what are they caused by? Because of the mutation, the ability of the virus to mutate. It's mutating all the time. It's a very simple answer. No brainer. And the new strains appear all the time. Particularly where healthcare systems are insufficiently prepared and the immunity levels are very low. For instance, African countries, they're still suffering a lot. Because the immune deficiency, they still, I mean, the HIV, AIDS problems are still very rife there, and they develop new strains of the virus, of the coronavirus.
Okay, that is Vladimir Putin of Russia in and giving his annual press conference as, of course, we look for anything he has to say on energy, gas supplies to Europe and the military build-up on the border of Ukraine. He's talked about inflation, he's talked about the growth outlook for Russia, and there was touching, of course, on the spread of the Omicron variant. Let's check in on these markets then. On December the 23rd, it was a lead up to the Christmas holidays. Optimism, of course, liquidity volumes are slim at this time of year. You're seeing gains of 0.4% across the benchmark. We're looking at the spread that's widened between the BTPs and the bunds on some more hawkish commentary from some ECB officials. Futures stateside pointing to gains of 0.1%. This is Bloomberg.
So what happens is that we create some icons, we call them tags, and they have a signal within them. And when you stare at that, your eye responds to it in a particular way. So the way in which that eye response occurs is a signal that we pick up on the visual cortex of the brain at the back of the brain. So the sensor is looking for the signals we create here that come through the eyeball, through the brain, and then onto the visual cortex. Once we've got it there as a signal, we can grab that, we understand what that signal looks like, and we can turn that into a command for whatever we're trying to control. There's multiple places where we think this technology can be applied, perhaps in, I don't know, driving or commanding unmanned ground vehicles or unmanned naval vessels, perhaps providing menu selection and control within a control room environment, maybe in a nuclear power station. All those kind of things are perhaps in the bailiwick of this technology.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
I think this is going to be a little bit of a dark winter in terms of just uncertainty.
There's a ton of speculation out in the marketplace, no matter where you look.
Q1 really looks in question given the impacts of Omicron.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Thursday, December the 23rd. Our top stories today. Omicron optimism. Astra's COVID booster increases antibodies, while a trio of studies shows the Omicron variant appears to result in fewer hospitalizations than Delta. President Biden speaks out on his re-election prospects, saying fate, health and Trump will guide if he runs in 2024. And Ukraine tension and the energy crunch are in focus as President Putin holds his annual year-end news conference, currently underway now in Moscow. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger in London. Kayleigh Lyons with us in New York. Matt Miller is off this week. And Kayleigh, we've had good news, haven't we? Certainly it's been taken as good news by the markets. Risk assets rallying on better news, at least at the margin, around Omicron and the rate at which it sends people to hospital and the ability to fight it with vaccines.
Yeah, you are seeing equities in the gaining today, Anna, but I would note as well that it is on pretty light volume considering it is the eve of Christmas Eve. Now, that was evident in the Asian session overnight. You did see stocks rising broadly across the board. The MSCI Asia Pacific Index up by about 0.9%. There's actually two individual stock stories I wanted to highlight from Asia, and that is Tencent and JD.com. Tencent announced it is offloading $16 billion worth of shares of JD.com as a special dividend payout, a one-time dividend payout. So a surprise move to offload most of its stake in that online retailer may help ease some regulatory concerns for Tencent. So that stock was up about 4.25%, but JD.com, on the other hand, down by about 7% in the Hong Kong session. Finally, I wanted to note that because there is more risk-on feeling today, you aren't seeing a bid for the safe haven Japanese yen. It is weaker against the dollar by about 0.2% at 114.32. Now, here in the U.S., of course, we aren't that far from record highs after the gains we saw on Tuesday and Wednesday. You are seeing some of those gains continuing, but not super strong at this point in the future session, up just about 0.1% on S&P E-minis. In the bond market, we are seeing yields inching higher. We're up about 1.5 basis points on the 10-year yield to just below 147. Crude is slightly lower, coming off of a one-month high, right now trading at 72.68. And then interestingly, though, even though there is some risk on sentiment today, Bitcoin not taking part. It is actually lower by a little more than 1%, trading at $48,400, Danny.
Kayleigh, it is also more or less a risk-on day here in Europe. Of course, as you were saying, eve of Christmas, which means that we are seeing volumes in some cases off by a third, in some exchanges half as much as it usually is in the 20-period average of this time. However, we're looking at gains about 0.25%, I would say, for most of continental Europe. Same goes for FTSE 100 stocks as well. This would be the third consecutive day of gains for European equities. Of course, you'll recall prior to that it was 2 consecutive days of losses, but this would be the longest winning streak in a little over a month when it comes to European assets. Now, we did see some gains in the pound at some points today, really driven by some of the UK data we got earlier in the day, pointing to a stronger recovery, a quicker recovery from COVID than had originally been expected. You continue to see the cable rate filter that through. We're looking at 0.4% gain at 134.01. And of course, as I have done every day this week, I continue to check on the lira. We're looking at another day of gains for the lira, up 5%. Again, on track for its best week since the 1980s, given that earlier this week we had the single best day of the 1980s, since the 1980s rather, given that we had Erdogan's government stepping in, trying to support the lira. And finally, the other assets I'm pretty sure I've been checking on all week also are natural gas in Europe. We're looking at now losses of about 18% in Dutch front-month futures. This had been sky high, and sky high prices mean that we're seeing more attraction to the European energy market. A lot of these LNG tankers that were perhaps on their way from Asia now diverting, going to Europe, helping at least in the short term to ease some of the supply crunch. But I should say we're still seeing demand destruction. One aluminum plant in France had to shut down due to the fact that prices for energy were just prohibitively high. Because of that, we're seeing aluminum rally, aluminum prices at a 2-month high, Anna.
Yeah, absolutely. The natural gas story, the price of that commodity having an impact on the industrial complex across Europe already. Interesting to see what happens to that and those LNG tankers as that price comes down then, Danny. Let's have a look at what is in store for us today. And first to something that is actually already taking place. Russian President Vladimir Putin is holding his annual press conference. The key themes will include and have included Russia's standoff with the West over Ukraine, NATO and international relations, although a lot of what he's been talking about already has been fairly much, pretty much the domestic agenda, talking about COVID and inflation. We will later today get some US data, including durable goods and initial jobless claims, and the US bond market closes for Christmas at 2 p.m. New York time. Stocks trade as normal. So just a little bit of an update on trading hours for you on this day before Christmas Eve. Let us get the latest on the virus then. The Omicron variant appears less likely to lead to hospitalizations than the Delta strain. Meanwhile, a third dose of AstraZeneca's COVID-19 has been found to increase antibodies against Omicron, but the head of the World Health Organization warned against blanket boosters.
Blanket booster programs are likely to prolong the pandemic rather than ending it by diverting supply to countries that already have high levels of vaccination coverage, giving the virus more opportunity to spread and mutate.
Food for thought from the WHO. Let us bring into the conversation Susie Ring, our healthcare reporter, to bring us up to date on all of these various news lines. Then, Susie, good morning. Let's start with our ability. I mean, we were hearing there about the dangers of boosting too much, perhaps, in developed markets. But in terms of the use of boosters, we've had mixed data today. Good data on AstraZeneca, which maybe for global audiences might have some relevance. Not such good data out of China, though, or out of Hong Kong specifically on Sinovac. Give us the latest.
Yeah, so we got data from Astra this morning that really follows suit with what we've seen from Pfizer and Moderna, kind of reconfirming that while 2 doses, of course, still does provide some protection, it's very much weakened by the Omicron variant, and a third dose looks to be necessary to make sure that that protection is neutralizing antibodies against Omicron was seen from a third dose in this study, and that they were in line with those individuals who higher than those individuals who recovered naturally from previous strains. This, as I say, very much kind of follows the pattern we've been seeing from government, recommending that the booster program is very much prioritised among populations to ensure that we can kind of protect as many people as possible as the Omicron variant rages.
Yeah, and Susie, Israel has also started to give even 4th shots to those 60+, and we are getting some headlines out of Israel now saying that the age 60+ age group infection protection was seen falling to 25%, so the transition to Omicron would leave people unprotected, but they say that fresh boosters will raise protection between 70 and 90%. But of course, Susie, vaccines, even if you get them, you could still end up with a positive case. The good news is there's several studies that indicate now that your chances of hospitalization are much lower in places like South Africa and Scotland. They've done this research. How does that vary, though, depending on the vaccinated versus unvaccinated population?
Yeah, we had a trio of studies come out yesterday, which was very reassuring, and obviously particularly kind of for the UK government and others at the moment that are trying to hold out against sort of imposing further restrictions before Christmas. The research yesterday said that the Omicron was associated with a 2/3 lower risk of hospitalization compared to earlier variants. And so we have to bear in mind the heavy caveat that it was still 10 times more likely than Delta to infect people. And of course, the more people that are infected, the more people you are going to see go to hospital. We also have to just weigh that with the fact that we don't yet have sufficient data on ICU admissions and deaths, which of course always lags a few weeks. And again, you know, we're talking about the general population here, but of course there are more vulnerable populations. For example, we've been writing about pregnant women this morning who are just seeing an increasingly worse situation. They were left out of clinical trials, and now they're really suffering the consequences from hesitancy among that group. And we're seeing more and more pregnant women hospitalized and admitted to ICU, and that's a similar dynamic across other vulnerable groups. So there are a lot of caveats to this data, but it is early good signs that Omicron may not be quite as severe as Delta and other variants that we've seen previously.
All right, thank you so much to Susie Ring, our healthcare reporter. Meanwhile, in Washington, President Biden says he'll run for a second term if he remains in good health, and would be even more likely to do so if Donald Trump is his opponent. For more, we're joined by Bloomberg government reporter Jack Fitzpatrick. Jack, President Biden also said that fate has a role to play here. But before we can get to 2024, we have to get through 2022 and the midterms. How much runway does the president realistically have left to get some of his agenda through?
He does not have that much time to get key portions of his legislative agenda through. As we get closer to the midterms, Congress really kind of essentially leaves Washington, and things get even more politicized and becomes more difficult to get everybody on board with a bill. So the Democratic lawmakers we've spoken to recently, including the House Budget Chairman, have said there's an opportunity to keep working on their main tax and spending bill, even with the delay that we saw from Senator Manchin. But there's a pretty narrow window. If it gets into the spring rather than the winter of early 2022. They're facing a really significant time crunch. And of course, in combination with that legislative agenda and the 2022 midterms, the fact that the president isn't polling very well really has been a weight on his party lately.
And Jack, halfway across the world, President Putin, starting in the past hour, has been giving his annual press conference. He's talked about everything from the mortality rate being high due to low vaccination levels. He said the U.S. Fed will have to do something about inflation. Now, as far as I can tell, he has yet to comment on geopolitical tensions with the U.S. What's at stake in regards to that, given that satellite imagery now shows Russian troops building up on the Ukrainian border?
Right. He has not, as of the last few minutes, made news on the troop buildup or on any energy-focused geopolitical issues. But obviously a major focus is that troop buildup of more than 120,000 troops within about 200 kilometers of the border of Ukraine. Even though Putin himself has not said anything in this press conference, there was some pushback from the deputy foreign minister from Russia in an interview that was published today in International Affairs magazine, saying that while the U.S. may want preconditions to be agreed to, some prerequisites in the January peace talks, Russia does not want to do that. They want, in his words, contractual agreements. So obviously Russia has continued to push back and say they have the right to move troops within their own borders as much as possible. But so far, Putin has focused more on his own domestic agenda, on the state of the coronavirus in Russia and on inflation, which is expected to be about 8% there this year, rather than delving into the foreign policy issues so far.
All right, Jack, we'll continue to keep an eye on that press conference. Thanks to our Jack Fitzpatrick of Bloomberg Government. Now, the energy crunch is also in focus as Putin speaks there in Moscow. Russian gas flows to Europe dropped sharply this week, and this is after buyers under long-term deals hit their contracted supply limits for the year. Let's get more with Anna Shirayevskaya, our EMEA natural gas reporter. Anna, how much of Russia not supplying more to Europe when it comes to natural gas is driven by geopolitics versus capacity?
Well, at the moment, we see that some of the European buyers of Russian gas have already reached their contractual limits, and we are seeing a sharp drop in supplies. Typically, Gazprom, with its clients under long-term contracts, set agreed annual volumes that buyers must take or pay for, and the seller has to deliver. And this supply comes at a certain formula, which actually made these supplies cheaper earlier in the year than the high price on the spot markets which we're seeing right now. So it did make sense to take that up volume earlier in the year. At the same time, uncertainty remains. This volume has a certain degree of flexibility, and it can be adjusted on a monthly and quarterly basis. And so at the moment, we have some concerns as to what supply will be in January, as only 21% of the pipeline, of a major pipeline to Germany, was booked for now.
So good morning to you, Anna. So we watch what's happening with Russia very closely. We also watch how global energy markets respond. And we've seen on the Bloomberg terminal the way that LNG tankers have been headed in one direction and then turned around to go somewhere different, to go to Europe, where we are seeing prices rewarding that kind of behavior. How much more of that are we going to see? How much can LNG fill the gap?
That's right. We're seeing a lot of tankers diverting away from China, from Asian markets to Europe, just because prices are so much higher on the continent compared to Asia, where buyers are more prepared for the winter, and the weather so far has been milder. As well, we're seeing a lot of LNG coming from the US, which is a flexible supplier and is the closest market to Europe. And obviously, it's just made sense for sellers to divert all of that gas into European markets right now. We'll see a wave arriving by the end of the year and early January, and then it remains to be seen how Asian weather plays out later in the winter. But for now, yes, we're going to see a lot of LNG coming to Northwest European markets by early January.
All right, thank you so much to Anna Shirayevskaya. Danny did it perfectly.
and I messed it up. Thank you so much. She's one of our natural gas reporters. Apologies for butchering your name. I'm going to get back to something I actually can talk about in a cohesive way, and that is stocks moving in pre-market trading here in the U.S. One of the big outperformers to the upside is Novavax. It released some efficacy data of its vaccine against Omicron, and it does look like that protection wanes. The good news that analysts are really positive on is that its booster shot seems to provide substantial antibodies. So that stock is up about 6% in early hours. Another stock that is moving higher is Tesla. Elon Musk, shocker, is selling even more shares, this time nearly $930 million worth, getting very close to have completed his offload of that 10% stake that he promised Twitter he would do. So that stock is up about 1.7%. And one final mover to the upside is DoorDash. It has won early on an agreement with a $100 million settlement to settle claims that it misclassified delivery drivers in Massachusetts and California as contract workers, independent contractors. So that may remove some kind of overhang on the stock. It is up the better part of 2% in early hours, Anna.
One to watch then, and all I'll say on the Tesla story is, are we nearly there yet, Kaylee? It feels like that one runs and runs. Now, coming up on the program, positive findings coming out about Omicron. We'll get back to that story. We'll discuss the market reaction, what this means for risk assets. Agnes Bellish joins us, Chief European Strategist at Barings, and how retail is being affected by the virus surge with Ram Ratnam of S&P Global Ratings. We'll talk global retail. This is Bloomberg.
When you talk about the commercial viability, the idea that these companies can actually make money off of this here, does this become, I guess, something that's niche in the sense that you have to pay several $100,000s to do it, or does it come back down to a level where just regular folks like you and me will somehow find a way to be able to take a trip up, and this can be a business model that will be sustained?
I think it's important to note that space tourism is a small segment of the overall global space economy. Space tourism accounts for $1 billion of a global $350 billion global space economy.
What's the rest of it?
$260 billion of that is satellites, manufacturing them, launching them. And these satellites we use in our everyday lives, whether that's to listen to the radio, to watch Bloomberg on our satellite television, or to navigate us to our destination via GPS. And I hope in the near-term future, we will add getting our internet from space.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Welcome back to Bloomberg Surveillance Early Edition. Well, we've seen the spread between BTPs and bunds get to the most extreme point in about a year as we continue to see some hawkishness from the ECB price, and of course, not as hawkish as the Fed. But how far can they go, if at all? So I'm looking at a chart for our radio listeners of various countries throughout Europe, the jet to GDP ratio. And for a lot of Northern Europe, it is pretty low. You look at Germany, it's easily below 80%. 1%. Same goes for places like the Netherlands. However, when you move more south, the debt picture starts to look more cumbersome. For example, Spain debt to GDP levels are at 122%, and Italy, really the standout, is 155%. Of course, this all comes as the ECB looks to tiptoe into tapering. Well, to discuss is Ben Ram, currency and rates strategist at Bloomberg and Live. Ben, how much can the ECB really embark on any form of tapering given this debt load across the country?
The short answer to your question, Danny, is that not very far. Because if you look at the inflation picture, yes, we have elevated inflation in the Eurozone at the moment, but they're going to look through it. And that means that, and there is one piece of statistic really that sums it all up. And that is, if you look at the front end bonds in around the world, across the G10 world, you will see that yields, we have seen bonds sell off at the front end, but it is the bonds of Greece that have actually rallied this year. And they kind of stand out like a piece of rock in that ocean of insanity. And that is really a telling statistic. And that tells us that, look, the ECB is not going to get very far with tapering, because what have they said in the last policy statement? They have told us that, look, there's going to be Uber accommodation. Yes, they are going to retire PEP. But then in comes APP, the longer running program. They're going to step it up substantially in the second quarter and third quarter. And that means throughout 2022, you're going to look for ECB stimulus, continued stimulus in the markets at a time when the BOE, at a time when Canada, at a time when the US, at a time when New Zealand, they're all going to be tightening rates. ECB is not going to be in a position to tighten rates.
Okay. We'll watch that then into the new year. Ben, thanks so much. Ben Ram of the Bloomberg Markets Live team giving us his thoughts on European debt and tighter ECB policy. Remember, you can get market analysis from the Markets Live team. MLIV Go is the function to use on your terminal. This is Bloomberg.
Worker perspective, a recent headline, you got Kellogg's Cereal Union says the latest agreement that they had was rejected. Deere had to finally make a union contract. How concerned are you about the longshoreman contract and union negotiations right now?
Well, we're some time away from that. The contract expires on the 30th of June next year, and both sides have told me that they'll sit down to the table and begin negotiating in May. These are always important discussions, and usually when the spotlight is on our industry. But there'll be some issues around wages. The industry is making a lot of money. The longshore folks would like to see that. Now, I don't speak for either side, but training and development of the workforce will also be key as robotics and automation are front and center. The workers cannot be left behind.
Yeah, but to that point, I mean, do you feel like the balance, though, has shifted? I mean, for so long, workers had a lot less negotiating power. Do you feel like the pendulum's shifting?
The International Longshore and Warehouse Union, which does work across 29 West Coast ports, is very strong and a democratic organization.
Now, will pricing have to adjust or not as a result of your greener ambitions?
We ran a big survey around 32 countries. More than 30,000 people took part. And as you say, there was a big gap between people that were worried about climate and people that were taking action.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Happy holidays from your Bloomberg family.
Surveillance Early Edition. I'm Kaylee Lyons in New York with Anna Edwards and Danny Berger in London. Now let's get the first word news. And the Supreme Court says it will hold a special session on January 7th to weigh challenges to Biden administration policies covering vaccine requirements for millions of workers. The announcement comes amid rising COVID cases and is an extraordinarily fast timeline. The court hadn't been scheduled to hear cases again until January 10th. The Chinese city of Xi'an has imposed a lockdown on its 13 million residents after mass testing identified 127 COVID infections. Residents have been told to remain in their homes and designate one person to go out every other day for necessities. It's China's biggest such move since the pandemic started in Wuhan approximately 2 years ago. And Intel is apologizing after its opposition to Xinjiang labor sparked a backlash in China. The chipmaker sent a letter asking suppliers not to use any labor or products sourced from Xinjiang, quote, in order to ensure compliance with U.S. legal requirements. Intel's continuing access to the Chinese market is crucial to its growth as it struggles with increasing competition. Coming up, we'll get back to the markets with Ines Belaish, Chief European Strategist at Barings, her thoughts on year-end and the year ahead as we inch closer and closer to 2022. This is Bloomberg.
The antibody responses produced by this vaccination is able to potently neutralize the virus and a number of variants of concern. A lot of the vaccines being developed currently require super cold storage. One of the great advantages of our patch is that we're able to remove the cold chain. We've been able to stabilize the vaccine on the patch for at least a month at room temperature and a week at 40 degrees. So this makes logistically vaccine rollout a much simpler proposition, removing the cold chain from transport.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger in London and Kaylee Lines in New York. Matt Miller is off this week. And Danny, it's interesting to think about all of the good news we've had over the last 24 hours or so, the trio of studies showing reduced hospitalization risk from Omicron, the better news out of AstraZeneca, or the new information from AstraZeneca around the effectiveness of boosters. But some of the negativity has been coming from China. We've heard about the Sinovac vaccine. Once again, some gloomy headlines about its efficacy, even with a booster dose. And now we see this new line saying that China is urging reducing citizens' mobility during coming holidays. So this isn't now entirely regional in China. They're urging reducing citizen mobility.
Right, and in terms of the regional picture, we definitely have seen lockdowns, the most recent of which earlier today, Xi'an, 13 million residents. So this will be the largest lockdown really since Wuhan itself was locked down. This brings again to questions when we had in the beginning of the pandemic. Do lockdowns in China and Asia in general mean more inflationary pressures? Is it an issue for manufacturing? Does demand in China waning because of that mean that we have issues for the entirety of global growth? It really does feel like we're just getting flashbacks of a year or 2 years ago.
Yeah, absolutely. And of course, for healthcare reasons, the Chinese taking the stance that they're taking, but they are taking a very different stance to the rest of the world with their zero tolerance policy. That's what we're focused then in terms of markets, Kaylee, isn't it? We're focused on the latest news flow surrounding Omicron, whether it's coming from China or perhaps more in the market psyche right now on the 23rd of December, the better news flow surrounding Omicron and the ability of Western countries to cope.
Yeah, the idea that hospitalization risk is actually much lower with this variant, and I think that is helping to aid risk appetite. We actually saw that in the Asian session. We're seeing it in the European session, where actually, interestingly, travel and leisure is your biggest outperformer on a sector basis, and we're seeing it here in the U.S. as well, with futures positive after 2 days of gains. We're getting closer and closer to those all-time highs. Right now, up 0.2% on S&P E-minis to just under 46.95. And I wanted to point out, too, that volatility is relatively subdued, right around the lowest level in about a month, with an 18 handle on the VIX. In the bond market, we are seeing yields inching higher, so a little bit of selling pressure. We're up a little more than 2 basis points on the 10-year Treasury yield to 147. And then I know we've been talking about it all morning, really, but natural gas futures coming way lower in Europe. Granted, we're coming from all-time highs, very, very elevated price levels, but nonetheless, a 22% drop today is notable. LNG from U.S. to the rescue, and I know Danny's going to have a little bit more on that in just a second. But as I mentioned, you do have the travel complex outperforming in Europe, and that is also evident in the pre-market session here in the U.S. Cruise lines like Norwegian and Carnival each higher by around 1.5% to 2% in early hours, and some of the airlines getting a lift as well. Delta and American each up a little more than 1%, Danny.
Kaylee, I love it when you set me up so well. I almost don't even need this chart, but you know, this is such a good chart made by our markets editor, Valerie. So I'm going to go ahead and do it anyway, even though Kaylee gave us that great roundup. So as she was mentioning, we've seen front month futures just plunge. I'm looking at ICE natural gas here. We've seen it plunge some 20%. And again, for our radio listener audience, I'm looking at 3 different natural gas pricings. The 2022 one is the one that's plunged significantly. However, if we look out at other futures, we look at 2023 and 2024, those have continued to steadily climb. For example, 2023 is now very close to crossing and becoming more expensive than 2022. So it does seem like the market is expecting some structural issues to last and for the energy crisis in Europe not to go away anytime soon, despite perhaps a very short-term reprieve. Let's dig into this more. Joining us now is Agnes Belaish, Baring's chief European strategist. Agnes, thanks so much for joining us. How much of a concern is the energy crisis for you when it comes to the European economy?
Yeah, so the interesting thing about these gas prices is that they're actually equivalent to oil having risen to about $260 per barrel, which is actually a lot. And the question really is whether can they grow more from here and actually double so that inflation would actually keep accelerating. If they don't, because that's actually hardly envisageable, then actually inflation, will remain high, but will not continue to accelerate. And the question in everybody's mind is, if inflation remains high and growth decelerates, will central banks, the ECB, like the Fed, will they actually be willing to return to more accommodative policies?
Agnes, very good to speak to you this morning. Thinking about the global trajectory in 2022, we were talking about this, Danny and I, just a moment ago. We've had some good news surrounding Omicron and the ability of maybe Western economies to withstand it. But maybe the signs for China are not quite so great. And obviously China plays an important role. We think about the humanitarian story there, but also it plays an important role in the supply chains globally. How concerned are you about the zero COVID policy that we see enacted in China and what that's going to do to port operations, factories and the like?
Yes, I've always been saying that we won't be out of this until everybody is vaccinated, because otherwise this forces emerging markets that don't have access to the best, most efficient vaccines to actually be tougher than otherwise necessary with managing the COVID pandemic. So it is an issue. And in fact, this fifth wave that we see here in Europe that will actually spread all around the world is adding to disruptions that already were left over by previous COVID variants. And labor shortages will probably worsen and actually increase those supply disruptions on top of the energy price issues that we were just discussing, where higher prices are not being replied to through higher supply. So what's happening in emerging markets and China in particular are actually an issue. But one has to hope, though, that that little by little the spread of the variant will create some type of immunity, and governments will, over the course of the next year, be able to release their very tough COVID management policies.
And yes, I wanted to ask you about credit markets, because I've spoken to two guests this morning with slightly different views. One said that there are no opportunities in corporate credit. It's all been nationalized, so much government and central bank involvement here. Another said, actually, there are opportunities in corporate credit if you step away from maybe the bigger names. What is your attitude towards, or your investment thesis around credit as we head into 2022?
Okay, so I have a little bit of a different story about where we are right now and what's happening, and I think this will allow me to respond to your question. And the idea is that we are not in the regular stage of the business cycle, and where we are at is actually amplified by very unusual ingredients like high savings buffers, as well as actually very little demand for credit, because firms like households are cash rich. In fact, in the US, firms have been deleveraging since March. The credit growth actually been negative on average 10% for the past 10 months. And in the euro area, the corporate credit growth is actually null, and consumers are only borrowing to buy a house. So these two factors, very high savings buffers, very high cash buffers at firms, very little demand for credit, provide actually room for this expansion to last longer, even though it might be interrupted by slowdowns result from viral fears, but without having to go through recessions like in a regular business cycle, which also means that this economy will be stop and go, and the downturns that we can see in credit spreads widening, or in the stock markets, which are also risky assets, can actually have further to go. And actually, this volatility that we see in their pricing offers entry opportunities for later.
Well, and yes, and part of the reason why this credit cycle has looked so different is that the Fed, for example, was very involved in the market providing that backstop. And I'm wondering how you view waning monetary stimulus, waning fiscal stimulus, and what that is going to mean for what the cycle actually looks like going forward. Is it going to be more like a normal cycle?
Well, that's the thing, because leverage is so low in this current type of business cycle, which is really not a cycle, but a structural shock, because leverage is so low. When you have central banks tightening, it doesn't kill demand the same way, or slow down demand, I should say, the same way that it does in regular business cycles where leverage is so high that central banks can hike rate and work through the credit channel to slow down demand. This does not work like that this time. It will probably work through financial markets, not feeling very good about it, as well as morale or sentiment or confidence that central banks might be withdrawing support. But if you look at what central banks have announced, the key word is optionality. And they have made their policy forward guidance quite clear, I think, that if need be, they will actually reverse their type of policy stance. But at this stage, what is announced is not such a big tightening. And even though they are intervening a lot, they are still tapering, and they still hold about 40 to 50% of the sovereign debt market and a large part of the corporate debt market. And they will have so far to reinvest those stocks of assets. So that really, if you think about it clearly, markets remain quite well supported.
All right, thank you so much for joining us. And yes, Belèche, Baring's chief European strategist, appreciate your time. I do want to bring some breaking headlines. We are continuing to monitor Russian President Vladimir Putin holding his annual news conference in Moscow. He is addressing now what appears to be tensions with the West and the situation in Ukraine. He says that Russia is facing, quote, constant pressure from the West, and that further eastward NATO expansion is unacceptable. He says the West needs to give Russia security guarantees now because it was crudely tricked Russia over NATO expansion. And finally, he poses a question, Anna, no more missiles at our borders. Is it too much to ask?
Yes, a continuation of this theme, speaking out against the what Russia sees as the expansion into its sphere of influence. I suppose that the NATO view, certainly the US view, is that Russia shouldn't have a veto on how far NATO goes eastwards. But we'll have to see how these lines go down with the White House. We'll continue to monitor this for details. Live Go is where you can find details of that press conference, which continues to take place. Coming up on this program, Retail Renaissance. We'll discuss how COVID has reshaped consumer behavior with Ram Ratnam of S&P Global Ratings. This is Bloomberg.
While India might be securing jobs for its highly skilled elite, complicated, uncertain taxes have pushed most foreign companies in need of cheap labor towards China. That's costing the economy an estimated $140 billion a year.
They've been saying they're open to the rest of the world, but there are still a lot of protectionist barriers on doing business with India.
To follow in China's footsteps and reach the government's goal of being a $5 trillion economy by 2025, India needs to create a model which succeeds both at home and abroad.
Protesters breached the Capitol.
Democracy has prevailed.
A flash mob decided to take on the shore.
A giant container ship blocking the Suez Canal. 1,000 new types of crypto coins.
Crackdown on tech in China. In the billionaire space race.
The Delta variant of the COVID virus.
Evergrande is the most heavily indebted developer.
Of the chip shortage.
Withdrawal of U.S. forces from Afghanistan.
We did not get everybody out.
Songs, you lie.
Rising energy prices.
In Europe, it's a huge crisis.
The Omicron variant has triggered a global rush.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards with Danny Berger in London and Kaylee Lines in New York. Now, 2021 has been a year of rebuilding as the world moves towards vaccinating the population against the largest pandemic in decades. Bloomberg's Ariel Berger reports on what's ahead for 2022.
According to Bloomberg's vaccine tracker, roughly 3.2 million doses of the COVID vaccine had been administered by the U.S. by January 1st, 2021, far short of the Trump administration's goal of giving out 20 million shots before New Year's Day. And the global vaccine effort hit a snag in the spring when vaccines developed by both AstraZeneca and Johnson & Johnson were suspended over blood clot concerns. Within a few weeks, both shots were declared safe to use following reviews by regulators in both the EU and US. Before the end of April, Biden hit his goal of administering 200 million shots in his first 100 days, as vaccines had been made available to all adults. The fight against COVID was gaining traction in the summer as vaccines rolled out globally. That didn't last long, as the ultra-contagious Delta variant surged across the globe. By July, the CDC had advised vaccinated people to put their masks back on in indoor spaces as breakthrough cases rose and the agency learned that vaccinated people could still transmit the virus. In the fall, the FDA issued emergency approvals both for booster doses and vaccines for children aged 5 to 11. But late in November, global financial markets sold off after South African researchers identified a new, severely mutated COVID strain that had the potential to evade vaccine protection, the Omicron variant. In response, many countries reinstated travel restrictions from African countries. Japan closed its borders to foreign tourists from all nations, and UK Prime Minister Boris Johnson advised anyone able to work from home to do so. With 2022 on the horizon, the new year will bring with it a lot of uncertainty and big questions about the pandemic's future, including, will vaccines need to be reformulated, and can any ground be achieved without vaccine equity? Despite a pledge of more than 1 billion donated doses from the US, many countries have vaccination rates of less than 50% of their populations, and that's where the virus is most likely to mutate.
Bloomberg's Ariel Berger there, no relation. Now, of course, that past picture in the year has been consequential for retail as well. Let's dig into that. Joining us now for a look at global retail's battle with COVID is Ram Ratnam, S&P Global Ratings Sector Leader for EMEA Retail and Consumer. Ram, as Omicron starts to spread throughout the globe, here in the UK, there are rumblings of a voluntary lockdown, if not a mandated lockdown. You do have some European countries locking down as well. What has that mean for shoppers' propensity to continue to go out, to continue to buy things during the holiday season?
Hi, Danny. So obviously you touch on a very critical point, and this comes at a point where we're looking at perhaps the most important month of the trading year for retailers, and clearly one of the metrics we are watching very carefully is the drop in footfall. So clearly, destination shopping centers, malls, we expect to see footfall sort of dropping by 25% compared to say a baseline of 2019. So this is really unfortunate for the sector, especially when a lot of the retailers were investing into the expectation that the Christmas would be a bumper one, especially especially because the third quarter was fantastic in terms of numbers, in terms of retail performance, and that kind of momentum continued right through to November, just before we heard the spread about Omicron, which is a new issue retailers have to deal with.
Well, given that this is the most important month and it's being curtailed and it's already been a tough year, despite, as you were saying, that strong third quarter, can retailers survive another lockdown at this point?
So clearly, I mean, there are some positives, even though the situation looks it's not a great time. But I think one of the positives we can look at in all this, and this is well reading into 22, is e-commerce is in a really good place, and retailers have invested in their supply chains and e-commerce and the distribution capabilities. They should be able to weather the storm. That said, I mean, the sector is very different. There are smaller retailers who would undoubtedly be significantly affected by what's going on, by consumers not stepping out of their homes. So there will be a kind of a slow recovery. There would be uneven performance as well. I think that big versus small retailers with solid brands, they will continue performing well. So there is that, there will be two-tier, performance outlook coming out of this pandemic, and which we've already seen actually. E-commerce really doing well and helping many retailers, offset some of the pressures they see in the physical stores.
Ram, do you see Omicron, for retail, is Omicron going to be broadly inflationary because of the disruption that we could continue to see to supply chains?
So Anna, that's one of the perhaps the most important fallouts of Omicron in our view, certainly, is that many retailers sort of worked through last few months overcoming the supply chain issues, inflation has been quite widespread. That said, in our view, we see big retailers, consumer goods companies being very well positioned to deal with inflation as it stood. There's a lot of capacity for the consumer to take some of the price rises we've seen over the months. We expect to see some of them feed through as we go through the festive season. Promotional activity is being really cut across the sector. All that was before Omicron, and now, of course, all the retailers we speak to are reevaluating what they do with the stocks they built up in the anticipation of Christmas. But going back to your point about inflation, I think one of the biggest worries we have is inflation around wages in particular. The commodity inflation is very much priced into products, but wage inflation, especially when you factor in the fact that many employees will not be able to turn up to work, there will be absenteeism, and a lot of those replacement headcount at the stores and restaurants, etc., they come at a higher price. So that will lead on to undoubtedly some pressures on the wage bill.
What are the self-help measures then that the sector can take, Ram, as they look ahead to 2022? We still don't know a lot about Omicron that we hope to find out in the coming months, and we'll see how that plays out. But what are the self-help measures? Just give me an example of one or two.
So the sector has been remarkably resilient, basically through a combination of government stimulus, which you've seen has been quite an important factor. But you do touch on self-help measures, which has been absolutely important for the sector ever since we've gone into this pandemic. And this ranges from a lot of operating measures. I'd sort of break it into operating measures around costs, managing costs, managing operations, investing into the supply chain, rejigging distributors, working through the supply chain to find efficiencies. So there are a host of operating measures which the sector has done. And one of the biggest ones has also been ramping up the readiness to go into the online world, into e-commerce. Some of the retailers are in different stages of e-commerce adoption, but a lot of them have done really well from an operating standpoint. On the financial side, again, from a credit rating perspective, which is an area we look at a lot, I think we've seen extremely favorable financial policies for the sector. So companies have been really focused on managing the liquidity, which has been quite abundant, as your previous speaker said. But equally, from a balance sheet management perspective, things have been pretty robust. And that includes even at many retailers, they cut down shareholder returns, they focused on working capital management, and a lot of hygiene aspects around financial management that really helped them overcome some of these challenges we've seen over the last few months.
Okay. Thanks so much, Ram. Good to speak to you. Ram Ratnam, S&P Global Ratings Sector Lead for EMEA Retail and Consumer. Good to speak to you about the retail sector as we draw to the close of 2021 and into 22. Later today, we'll continue our retail conversations by diving into brick and mortar with Site Centers CEO David Lukes. That conversation at 2:30 p.m. in New York, 7:30 p.m. in London. This is Bloomberg.
Urban areas are most vulnerable to climate change. Cities consume 78% of the world's energy, while also generating 60% of greenhouse gas emissions. By the year 2100, 85% of the world's population is expected to live in cities. 90% of all urban areas are coastal. And with sea levels rising, 800 million residents are likely to be affected. 1.9 degrees to 4.4 degrees Celsius is the projected increase in urban temperatures around the world by year 2100. By 2050, 1.6 billion people are projected to be vulnerable to chronic extreme heat.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger with Anna Edwards in London. Now, a look at what we're watching today. Anna, I'm focused on the U.S. consumer. Yesterday, we had conference board numbers on the U.S. consumer for December, rose more than expected, significant, especially because of Omicron. But we had economy, feelings about employment, all of those rising. And so we have University of Michigan later today. And so I'm watching that because typically UMich does trail behind the conference board's figures.
Yeah.
But can they catch up? Are they also confident? Of course, Danny Blanchflower over at Dartmouth has long been saying that the consumer, if that attitude starts to fall, that basically forecasts a recession. So can we escape that?
Yeah, so based on the US consumer is the US economy. I'm focused on what's going on in Russia right now. We have Vladimir Putin giving his press conference, talking to the media in Russia. He spent a lot of the early hour of the conference talking about domestic issues, but then moved on to talk about NATO. He wants a security guarantee from the West. He said he wants no more missiles on the border. These lines we've heard before, and there are talks that will be coming. He's also waded in on the subject of gas. Gazprom is not responsible for the EU gas price, he says, and Yamal Europe was not booked as clients made no requests. So some of the lines coming out from Vladimir Putin as he continues to give that press conference. We'll continue to watch the gas price and LNG tankers coming from the United States. More Bloomberg surveillance is ahead. This is Bloomberg.
An extra $1 trillion in spending not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the president's agenda, what I like to call the big deal, but Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of health care, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
Access the financial world on demand. Hear from leading economists, policymakers, industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
What we're looking at is we're looking at a more hawkish Fed.
We are in a chronic labor shortage that's not going away anytime soon.
We're not completely done with some of the inflationary pressures.
We keep having the problem of the recession coming back and hitting us again. It's called COVID.
The market needs to revisit the risk of policy error at this point.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning. This is Bloomberg Surveillance. Kaylee Lyons, Damian Sassower, and Anna Edwards, and for Tom Keene, Jonathan Farrow, and Lisa Abramowitz, all are off today. Today, of course, being Christmas Eve. Santa Claus is coming to town, Anna, and Santa Claus seems to have been coming to the markets because that rally continues.
Yeah, absolutely. The rally does continue. We're up around 0.5% here on European equity markets. The man in red grabbing hold of the reins then and taking us higher for the moment. But we've had good news, haven't we? At least at the margin, and at least if you skew your view towards Western economies, we've had good news around the fight against Omicron, whether it's the trio of data releases that talk about reduced hospitalization risk, or whether it's better news on the AstraZeneca booster. All of that looks good. It's less good when you look at what's happening in China right now, and that, of course, has humanitarian health implications, but also supply chain implications looking ahead.
Yeah, the entire city of Xi'an, 13 million people being shut down. And Damien, it goes to show you China's COVID zero policy may not just impact China specifically. It could have ripple effects through the rest of the world.
Yeah, and certainly into emerging markets. But let's take a step back. I mean, I'm going to play Lisa Abramowitz here. I'm going to be the bear. Despite what we're seeing here in equity markets, for me, this bull market seems to be struggling from sort of a mid to a late cycle. You've got treasury yields basically expected to rise in the new year. Inflation is going to remain persistent. So yeah, I'm a little bit sanguine on what we're seeing here this morning and what is, basically a low volume day.
Damian Sassower channeling Lisa Abramowitz. Anna, do you want to be Tom or John? I'll let you take the pick.
I don't know. You cast me in whatever role you like. But Damien, it's an interesting point Damien was making there about, and it's one we've talked about quite a lot this week. Where on earth are we in the cycle? Because it depends if you're looking at the economic cycle, whether you're looking at financial markets, and not all of those are giving you the same clues. Whether you're looking at credit markets, have we destroyed the cycle entirely? I talked to one guest who told me we'd nationalized corporate credit earlier on, as if this was wartime. So where are we in the cycle? Seems like a really easy question to ask and a hard one to answer. I don't know. Was that Tom or John?
Well, Anna, for me, look, this is very reminiscent of last year, right? When you saw that, kind of pro-cyclical, shift, to value, markets tried to digest it and then it just flushed it out in the first quarter. And I think that's what, quite frankly, investors are a little bit reticent about this morning. The fact that, hey, are you going to put that trade on again? The reopening reflation trade, it burnt you last time. Let's see what happens again.
Okay, well, let's have a look at the markets then. Let's check the markets and see where we are on futures. E-mini futures are up, but just by 0.25%. So to Damien's point, are we losing a little bit of steam here? We do see the Stock 600 up in Europe, up around 0.5%. Some of the markets, in particular the Spanish market, up by more than 1%. So there's a little bit of Santa Claus rally perhaps in the mix there. We've got the euro in for you, pretty unchanged. Should have had the pound. If we put the pound in, that's up by, 0.5% today. Up by 0.5% against the US dollar, 134.19, just in case you've got travel plans around Christmas. I'm not sure everybody does this year. Not quite the year for it, maybe. US 10-year yield, 1.47%. New York, we've also got in WTI crude, 72.78. A little bit of movement in the euro there, but the story around the pound is the market increasingly pricing in rate hikes, and that seems to be something that has grown in momentum as we saw the Bank of England hike rates just earlier on this month. But of course, that is a global story, Kaylee.
Absolutely. I mean, the Bank of England already has lifted off. The question is, when is the Fed going to do so? We'll get a better read maybe of the need for the ability to do that when we get some economic data here in the U.S. It's going to be streaming out all throughout the morning, but at 8:30 a.m. Eastern time, we're going to get a bunch, including jobless claims data, personal income and spending, course PCE deflator, and durable goods. Of course, we're going to watch the deflator PCE print because that is the one that the Fed watches. It's their preferred inflation gauge. We're expecting 5.7% on a year-on-year basis. And then when it comes to personal income and spending, how much are incomes lagging behind inflation? And what does that mean for spending, especially as consumers have to start drawing down some of their savings? It'll be interesting to see how those reads shake out. And kind of along those lines, at 10 a.m. Eastern time, we're going to get UMich consumer sentiment. How is the consumer feeling? Judging by the conference board print yesterday, they're actually feeling quite well. It actually exceeded expectations all the way out at a 115. We're expecting the UMich number to come in more in the 70s today, but of course we'll be paying attention as well to the inflation expectations, both in the next year and out longer from 5 to 10 years. And then finally, one note, at 2 p.m., the bond market will close for trading. Stocks trading as normal all the way out until 4 p.m., but it's a shortened session for the Treasury market, given it is Christmas Eve, Anna.
Okay, let's talk about inflation. Mike Holland, chairman of Holland and Company, joins us this morning to do just that and to expand the conversation from there. Mike, good to speak to you. Thanks for joining us here on Bloomberg TV. What do you think central bank policy can do against inflation right now? Because you say, ahead of our conversation in your notes, you say there's too much money chasing too few goods. And so that makes me realize that the taper can't do much about the too few goods, but it can do something about the too much money. So what kind of downward pressure can the Fed bring to bear on inflation, given some of it is driven by those supply chain issues?
And such an important question, and I'm not sure that Jerome Powell, if he were sitting with you right now, could answer that, because he has all of these tools which he employed brilliantly 15, 18, 20 months ago, and has started out one of the epic salvage of the U.S. economy missions that any Fed president has ever done, Fed head has ever done. Right now, they are in a period where they are losing a little bit of confidence, in addition to their persistence with that word transitory on inflation. A couple of the Fed presidents, regional presidents, have had to resign because of claims of some insight or whatever. But I think the luster is a little bit off the Fed. I think that Powell has shown that he can do well in trying circumstances. Right now, I think it's pretty well inbred in the population, as Kaylee was just saying, that we have inflation, particularly the wage price spiral kind of inflation from the 70s, that is so inimical to a good economy. So he's got his job cut out for him. I don't think he would be able to answer the question is, what will he do? Because they have lots of tools, some of which aren't going to work.
Well, and depending on what tools they use, how high would you put the odds of a policy mistake, Mike?
Oh, Kaylee, that's I don't even want to talk about it, because with rates where they are now, which are at historic levels, historically bad levels for the Fed, they don't have much room to do anything with them. The supply of money, however, which is rarely talked about by the people who come out of the show and talk about what the Fed can do, and they're talking about rate hikes and so on. I think it's the supply of money, which has been too few goods chased by a lot of money, is what's causing this. And the wage price spiral is going to persist long after the services and other kinds of inflation. Commodity inflation is already looking better. I think the virus is, as of this morning, officially being retired by the markets. I think inflation is the big bogey over the next 6 to 12 to 18 months.
Mike, what do you think would be the bigger event for the markets? When the Fed ultimately does lift off and we get that first rate hike, or when QT begins and we actually start rolling off that balance sheet?
Well, between the two, Kaylee, the balance sheet is the key. It's the amount of money going into the system, but they're both important, because the market is determined to a great deal by psychology. Psychology has been waning recently with regard to favoritism toward the Fed. So I think that they have to do smart things, but I think that in the end of the day, it's the supply of money which will be the key.
The proverbial punch bowl, as it was, Mike. I mean, for me, I have one question for you. Are bonds dead? I mean, if one more person tells me to get short duration, move up in quality, maintain ample liquidity, I may just blow my brains out. For me, what serves as a store of value in this environment?
Well, Damien, I think beware the bond market. It's almost baked into the cake, the Christmas cake here, that you can lose money in a meaningful way over the next 12 months in terms of if interest rates move up. I should say when interest rates move up. The Fed has to move interest rates up. The bond market, unless we go into a serious recession caused by, in part, rates going up, the bond market is going to have a very negative reaction. So you're going to lose money. Just a question of how much.
And so then what about the risk of a policy error, Mike? I mean, do you think the Fed can actually taper without causing a tantrum this time around?
I think, Damien, that Jerome Powell is very savvy. I think he watches the markets. I think he'll do his best to avoid that. But I think, unfortunately for us as investors and as citizens, the possibility of a mistake is relatively high.
All right, thank you so much for joining us, Mike Holland of Holland & Company.
On that note.
Appreciate your yes, happy holidays to you, and thank you for joining us on a holiday week. Your time is even more valuable for that reason. Thank you for the insight. And as we talk about the Federal Reserve, Anna, we also have to talk about that there's some open seats, and in theory, the Biden administration is supposed to tell us who they want to sit in them by the end of the year, but we still don't have answers.
Yeah, absolutely, and it is a body that makes these decisions in its entirety, isn't it? Rather than it just being all down to Powell. It was interesting at the time when we were hearing about Powell's renomination. There were a lot of names thrown around. We'll see whether the names that are then put onto the FOMC sort of complement Powell or come from the same cloth. We'll have to wait and see how that pans out in 22.
Yeah, I was talking to Alan Blinder, who was a former Fed governor, a few weeks ago, and I asked him, will it shift the balance depending on who sits in those seats? And he says, at the end of the day, the Fed isn't really a democracy. It is chairman-led, Damien. Ultimately, it's Powell that's calling the shots.
Yeah, no question. And look, I mean, U.S. Treasuries, we've never seen 2 consecutive years of negative total returns for U.S. Treasuries. And quite frankly, I think that's what's in store coming here in 2022. We're having a negative year here in 2021. I think we're going to see more of the same in 2022, given the path of Fed rate hikes.
Yeah, the question is, when does that actually start to show up? Because on this morning, December 23rd, I am still looking at a 10-year Treasury yield that is south of 150. I don't think coming into this year, anyone thought we would still be that low, maybe aside from Steve Major over at HSBC, Anna.
Yeah, absolutely. I mean, where is Steve Major? We'll get him back on to talk about where we go in 2022. But I'm just looking back over the year that was, and yeah, we got up to the 1.7s, didn't we? And at that time, we were all thinking it was plain sailing to 2. It didn't turn out that way, Kaylee.
It did not, and of course, tech felt that burn at that time. But tech doing pretty well this morning. Nasdaq 100 futures are up about 0.2%. When it comes to S&P E-minis, we're up a little more than 13 points, just shy of that 4,700 level. The 10-year yield sitting right at 147. This is Bloomberg.
With the first word news, I'm Ritika Gupta. The Supreme Court says it will hold a special session in just over 2 weeks to weigh challenges to 2 Biden administration policies covering vaccine requirements for millions of workers. The High Court's announcement that it will hear arguments in the cases January the 7th comes amid rising coronavirus cases and is an extraordinarily fast timeline. The court had not been scheduled to hear cases again until January the 10th. The Chinese city of Xi'an has imposed a lockdown on its 13 million residents after mass testing identified 127 COVID infections. Residents have been told to remain in their homes and designate one person to go out every other day for necessities. It's China's biggest such move since the pandemic started in Wuhan approximately 2 years ago. And Intel is apologizing after its opposition to Xinjiang labor sparked a backlash in China. The chipmaker sent a letter asking suppliers not to use any labor or products sourced from Xinjiang, quote, in order to ensure compliance with U.S. legal requirements. Intel's continuing access to the Chinese market is crucial to its growth as it struggles with increasing competition. Russia is continuing to build up forces close to Ukraine, even as it's preparing for security talks with the United States. Russia now has 122,000 troops within 120 miles of the border. The U.S. and its European allies have warned Russia of massive consequences if it attacks neighboring Ukraine. As they struggle to decipher President Vladimir Putin's intentions, the Kremlin denies it plans to invade. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
What do we know and what don't we know? Because there's a lot of speculation, a lot of anecdotes circulating right now.
Omicron definitely has the characteristics to create us concern for many reasons. But also we have been preparing for a moment like that for months right now. And I feel comfortable that the playbook will work. So what is the playbook? One, it is to understand more about this virus. The second, of course, will be to protect against infections. And the third is to treat. Let's take it one after the other to understand. I think there are a few things that are not very clear yet with Omicron. One, it is the clinical manifestation of this new virus. Is it creating more severe disease or not? Is it transmitted easier or not? Is it going to younger or older people? All of these are things that, as we see clinical cases coming out and the numbers are getting bigger, that's something that we will know in a few weeks.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Protesters breached the Capitol.
Container ship blocking the Suez Canal.
Types of crypto coins.
Crackdown on tech in China. The billionaire space race.
Delta variant.
Chip shortage.
The rising energy prices. The Omicron variant has
If I'm in the health I'm in now, if I'm in good health, then in fact I would run again.
And if that means a rematch against Donald Trump?
You're trying to tempt me now. Sure. Why would I not run against Donald Trump for the nominee? That increased the prospect of running.
Donald Trump, his health, and also fate, 3 factors that President Joe Biden says will help decide whether or not he seeks a second term. But before we can get to 2024, we have to get through the midterms in 2022. And to get to 2022, we have to finish out the final 6 trading days of the year. So let's look at how things are shaking out in futures trading at the moment on this December 23rd. The Santa Claus rally looks like it is continuing after 2 big updays for the S&P 500. We are very close to record highs. Futures up about 0.25% to 46.97 at the moment. Not a lot of action when it comes to FX. Euro dollar essentially flat on the day, right at 113.25, while the 10-year yield in the U.S. ticks up 2 basis points. 147 is where we sit. So let's get back to politics and head over to Washington, D.C., where Jack Fitzpatrick of Bloomberg Government is joining us. Jack, the 2024 picture is probably going to be decided by the midterms in 2022, no?
Well, I don't know necessarily if the 2024 race would be decided by 2022, but it certainly will be colored by it. Right now, Democrats see one last chance to get as much of their legislative agenda through as possible, because there really is an expectation that Republicans are going to pick up at least one of the 2 chambers of Congress in the midterms, especially with the president's really tough approval ratings weighing on his party. So this really, what you've heard about the tax and spending bill and the pressure to get something done before everybody gets out on the campaign trail is reflective of the expectation that, as usual, the first midterm after a president comes into office is really, really tough for the president. That may not be pivotal in 2024, but it makes things very difficult right now for Democrats.
Jack, good morning. On the Build Back Better and linking that into the votes that you're talking about there, do the 2 have a bearing on each other? Does the ability of the Biden administration to get this through, despite all the opposition, despite things not looking great for the Build Back Better fiscal stimulus package right now, does the fact that the midterms are fast approaching, would it make a difference if the Democrats proved that they were able to get this through?
Yes, I think Democrats, mainstream Democrats, even moderate Democrats who had some misgivings about the Build Back Better agenda and the process, really want that to be able to campaign on. Obviously, they do have the initial stimulus response to the coronavirus. They have the infrastructure bill that was bipartisan. This bill is sort of a major cornerstone of what Democrats, from the progressive wing to pretty much the moderate wing, wanted to be able to campaign on. So each one affects each other. The time time crunch to get onto the campaign trail, and the difficulty looking at the polls right now makes it a little bit more difficult to get this across the finish line. But even, we spoke earlier this week to Carolyn Bordeaux, a moderate swing district member in Georgia, who had some problems with the process of this bill earlier. Even she said she was disappointed with Senator Manchin for holding it up. She supports this. She wants to see it end up in law. So it's something they're really pinning their hopes on going forward.
Jack, obviously there's questions around that longer-term stimulus down on Capitol Hill, but in the shorter term, I know you spoke with Republican Representative Tom Cole of Oklahoma yesterday on Bloomberg Radio, and he told you there was a possibility of an early 2022 supplemental bill to support the Omicron response. Could we actually see agreement on a different kind of support before we see agreement on Build Back Better, if at all?
In a limited way, yes, that is the kind of thing that could end up getting bipartisan support. Congressman Cole is actually the top House Republican on the subcommittee that's responsible for funding Health and Human Services. He brought up that a few weeks ago, before Omicron really got going, he and Javier Becerra, the HHS secretary, had a conversation, and it was expressed that that may be necessary regardless of new variants, to have a new bill looking at hospital capacity, testing capacity for future waves. It's the kind of thing that could be bipartisan. I would point out, though, Republicans would probably want to reallocate some of the previously appropriated money from the American Rescue Plan that they opposed. So there probably would be some controversies over how to address that. But it's the kind of thing that early in 2022 is possible, even on a bipartisan basis.
Yeah, Jack, I mean, do you think President Biden's weak approval ratings are the reason we're not seeing a more stringent lockdown here in the U.S. due to the Omicron variant? And further to that, I mean, should we just pencil in a Republican Congress come November of next year? I mean, what's the story there?
Well, the political calculus here, I think in both parties, seems to assume that Republicans will win at least one chamber, and that we're going to have a divided government, and that this is the last chance Democrats have to use the budget reconciliation process to get something through on a partisan line to the House, Senate, and White House while they still have it. There may be some political pressure when it comes to whether to go into a true lockdown. Obviously, there really are substantive differences between where we are now and where we were in March or April of 2020 with the number of people that have been vaccinated. For example, when the president says that he may be open to reducing those travel restrictions from Southern African countries, that was meant as a short-term or shorter-term measure to try to buy more time. At this point, they're trying to press people to get vaccinated because that's an obvious solution. So there may be some political pressure to say we can't go fully into lockdown, but also it really is the case that there are other solutions there available to us.
The policy approach to the virus very different here in the U.S. and to some extent the UK, where Anna is, relative to other parts of the world like Europe. Thank you so much to Jack Fitzpatrick of Bloomberg Government joining us down in Washington. And we go from Washington to Ankara and really the rest of Turkey. Damien, this is your wheelhouse. The Turkish lira appreciating against the dollar. We are now sub 11 once again.
We are up 11% on the day, Kaylee. It's quite unbelievable. Look, we know that Erdogan basically passed that legislation where the government is now going to backstop any lira losses on local lira-denominated deposits. That's what kind of drove the recent rally. But, I mean, 11% today, where now you're right, back in the 10s. We were in the 18 handle just, last week. I mean, this is almost a doubling of the lira. I mean, this is just, it's just an unbelievable move, unprecedented.
And Damien, when we've heard a lot from President Erdogan, of course, this week, and we heard about that new policy, and it's designed to persuade, average Turks to not want to convert their currency into dollars. From what we've heard so far, just briefly, do you think that can be successful?
Well, I mean, there's $265 billion, Anna, of hard currency deposits within the Turkish banking system. So now the Central Bank of Turkey is basically going to backstop all of that. If it all comes back on shore, I mean, good luck with that. I mean, that can't be good for Turkey's fiscal situation. I expect the fiscal deficit to GDP is probably going to rise. But more importantly, what if the lira does depreciate now? I mean, that means, quite frankly, they're going to have to print a lot more money. Their monetary base is going to expand, Anna, and that's never a good thing for inflation.
I literally don't remember the last day we didn't talk about the Turkish lira, Damien. I know that probably makes you very happy. The Turkish lira stronger against the dollar today. The dollar broadly is slightly weaker. And as we look at other U.S. assets, we are seeing futures in positive territory. We're up another 0.25% or so on S&P E-minis, just shy of the 4,700 level. The 10-year yield ticking up 2 basis points to 147. Stick with us. This is Bloomberg.
Front, when your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
Santa Claus may not be coming down the chimney until tomorrow night, but he definitely has already come for these equity markets because the Santa Claus rally is well underway. We are very close to all-time highs when it comes to equity markets here in the U.S., and futures are in positive territory after 2 days of gains. S&P 500 E-minis up about 0.3% right now, right at that 4,700 level. You're seeing gains really broadly across the benchmarks, including a little bit of outperformance for the small caps. The Russell 2000 is up about 0.6%. Switch up the board and take a look at the bond market. Some movement in yields, nothing too dramatic, but we are ticking higher on the 10-year Treasury yield. We're up a little more than 2 basis points. 147.55 is where we sit. There is more movement once again at the longer end than at the short end. On the 2-year yield, we're up less than 2 basis points to 67.79. One other story I wanted to mention is what's going on over on Anna's side of the Atlantic, and that is a lot of volatility when it comes to European natural gas prices. What we're looking at here is the benchmark Dutch front-month futures. We have seen so many wild swings this week. It is down about 18% today alone, but really that just brings us to essentially still higher prices on the week because, of course, you saw that big movement upward earlier this week, Anna. It's cold over where you are. There's a lot of concern about Russian supply, but the optimism today is that U.S. LNG may come to the rescue.
Yeah, absolutely. The map go function on the Bloomberg working overtime to show you those LNG tankers not going to Asia, as they so often do, but instead coming to Europe where they can get those higher prices. Let's bring into the conversation or start a conversation around currency markets with Win Finn, who joins us this morning, Global Head of Currency Strategy at Brown Brothers Harriman. Win, I want to start a conversation on the Turkish lira, and then I'll hand over to Damien, and you guys can carry on with that because there's a lot to say, I'm sure. I remember a day when 10 lira to the dollar was considered sort of weak, and then we got to 17 or so, and that gives you a different perspective. But now we're down at something with a 10 handle. Where do you see the Turkish lira heading from here? To Damien's point earlier, there are a lot of banks, a lot of brokers, a lot of FX houses that have stopped covering this currency. So what are your thoughts on this?
Yeah, I know it's a good point. The liquidity is very thin in this market. There's not a lot of participants that are willing to really stick a neck out and make prices on Turkish lira. I would say that, if anything, I would say that the